President Savona, distinguished authorities, ladies and gentlemen, good morning, everyone. I'm particularly pleased to host this important session of the Italian G20 presidency in this magnificent building, let me say that, which has been the seat of the Council of State of Italy since 1889 and represents a skillful synthesis of the late Renaissance and Baroque periods. The format chosen for this meeting, a mix of face-to-face and online participation, is a sign that we can look to the near future with renewed optimism. The theme chosen by Consob for this session is of the utmost importance. Before COVID-19 hit in 2020, sustainable finance, also known as responsible finance, was on a clear pathway towards success. All major financial institutions were making public commitments to environmental, social, and governance investment. Then the pandemic struck. Suddenly, private capital was not assumed to be the sole driver of social impact, and the public sector's role was put in the spotlight. Protecting the health and safety of workers, improving health services, securing and developing urban areas are some of the issues on which financial players are focusing. The interest of finance in social issues could make a significant contribution to combating inequalities, which have worsened as a result of the pandemic, Italy included. The health crisis has accentuated not only income inequality, but it has also had effects on generational and gender inequality. If we raise our eyes to what is happening in the world, the United Nations estimates that the people living in poverty worldwide will increase by between 40 and 60 million as a result of the pandemic. As President of the Council of State of Italy, I believe that a clear framework of rules in order to preserve confidence in the financial system, the protection of investors and the stability of the financial system would be required. It should be stressed that for the Council of State, this applies both to its advisory and judicial functions. And the Council of State, as court of last resort, deciding on the legitimacy of regulation, considers the following to be an essential condition for economic recovery. Firstly, clarity of the regulatory framework. Secondly, the use of genuine consultation in drawing up regulations. In the years to come, the international community will need to show courage and ambition in order to overcome today's great challenges. These range from the post-pandemic recovery to addressing climate change, from supporting innovation to overcoming poverty and inequality. The development of sustainable finance requires global cooperation, and coordination is necessary in order to adopt a common set of rules and practices and prevent opportunistic behavior and regulatory arbitrage. These are the reasons why the Italian presidency of G20 is keen to place these issues at the top of international agenda. Dear President Savona, distinguished delegates, I'm sure that for all these reasons, this meeting will not only foster a fruitful exchange of ideas related to crucial issues mankind is currently facing, but I am also sure that our daily work as judges will benefit greatly from your discussions. And now I wish you a productive meeting, and thank you.
Chi è che muove le slide? Okay, thank you. Following the President Filippo Patroni Griffiths' welcoming address, We are here in this beautiful location of the Italian Council of the State for our first G20 session as Consob, the Italian Financial Market Authority. I would like to start my contribution today by thanking all of you here, speakers and audience in presence and in remote. We thought in this challenging time for the world that it was important for us to contribute to the work of the G20. I have been given the task of introducing to you this conference, which is developed under three main themes: regulation, innovation, and the financial sustainability. We are living in a very interesting time, perhaps too much interesting. Tech innovations for finance create a discontinuity in the ways and means that the market operators and public authorities usually know and use. Market operators run faster than public authorities and communicate through social and traditional media instead of using large and heavy official documents, as authorities usually do. People follow short and incisive messages. The question we are posing today at the conference, which connects these three themes, is: can we square the circle? Although a difficult task, it is nevertheless possible to achieve. The core of my contribution will be to explain how we now have the opportunity to square the circle, thanks to the collaboration and the connections that we can create first and foremost across regulators. At the base of the current debate on fintech, there is a social dilemma between economic freedom and the protection of less informed savers. It is well known that information asymmetry undermines efficient competition. Tech innovation in finance can exacerbate this asymmetry, and in principle, it can affect the allocative performance of financial markets to produce income and employment, and is now enlarged to environmental social governance, ESG issues. G20 has already acknowledged the relevance of the technological transformation and is planning to regulate the new financial landscape. In the meeting held on the 13th of October, G7 has reaffirmed the importance of a strong international coordination and cooperation on innovation in digital money and payments, and endorsed 13 public policy principles for retail central bank digital currency to support and inform domestic policy in this field. Consob, like many regulators around the world, in fulfilling its statutory objectives and safeguarding integrity, stability, and the transparency of the financial market, as well as protecting savings as guaranteed by our Constitution, must define detailed rules and norms to identify the regulatory framework. In doing this, Consob would be remiss if it did not fully take into account these booming waves of innovation. This process leads also to a great diversity of players, services, and products that have highly increased the possibility of a regulator blind spots and blind activities lying outside the stringent and well-known regulatory perimeters. This trend have produced, as a consequence, not only a fragmentation of the action by several regulatory agencies, but also an asymmetry in the definition of rules, since national and international regulatory agencies often respond differently to different priorities and mandates. In this situation, regulators are sometimes acting as if trapped within a pendulum motion, moving from light touch regulation to more stringent regulation. In this context, the real risk is the proliferation of hodgepodge of several regulatory frameworks across different regulatory agencies, which may be very fragmented and perhaps have many overlapping and inconsistent aspects. The cause of this risk may be found in the current silos system of a specific sector, regulation agency, each operating in its own field. This system is ill-equipped to deal with the pressing technological disruption that we are experiencing today. For instance, the operational and stability risks, such as those posed by the spread of cryptocurrency, are often moving outside the current regulator and the supervisor perimeters, thus showing that the boundaries of these perimeters are becoming more and more blurred. In addition, the unprecedented development spurred by the digital and the technological innovation are enabling many more countries, particularly developing countries, to enter financial markets. These countries are often the birthplace of many innovative financial products and services, and thus rely on specific regulatory bodies, often aiming not only at financial stability, but also at inclusion and sustainable growth. This two-pronged approach poses new regulatory challenges, as global rules and standards have rarely considered these values within their scope. We have the necessity to support a regulatory dialectic with innovation, but I would like to place emphasis here on the notion that the financial innovation technology and the digital disruption not only hold the promise of many benefits for society, such as broadening financial inclusion, but also raise many distinct threats. Some threats relate to some of our most important economic and social values and the epicenter of our lives, such as privacy, competitiveness, integrity, and the stability of the overall macroeconomic system. On one side of the coin, we realize that in order to encourage technological innovation, regulatory authorities will need to revise their processes and operations. But let us examine the other side of the coin. Among the many financial technological innovations, for example, there are machine learning algorithms used to identify our credit scores, robo-advising platforms that help us to decide how to invest our pensions, and blockchain systems that issue new currencies for our daily life. It is patently true that all technological financial innovation will always work more effectively and efficiently when they are built on the foundation that comes from the experience of independent authorities acknowledged by government, like Consob and many others. Regulation provides not only a boundary, but also legitimacy for innovation. From the standpoint, I believe that the regulation should be at the forefront in the digital innovation process and development because it provides a confidence building and a trust in the financial system. In this important role given to the regulation, regulators should rise to the challenge. What do you mean for challenge? As regulators, we need to aim to strike a correct balance between innovation and the risk, and to adopt an affirmative but cautious approach to the significant conceptual and the technical progress of this period. These elements are needed to lead us towards the shift in regulatory paradigm. The three elements are experimentation, transversality, and international coordination. First, I strongly believe that a regulation should be considered as a complementary source of innovation. I will give you just one example to strengthen this assertion. The economic and financial crisis of 2008 resulted one major regulatory reform in Basel III directive. Basel III financial reform has been seen by many as the possible gravestone for financial innovation. Instead, the opposite has happened, and we have witnessed the last decade an incredible flourish of financial innovations never seen before. Within this context, it is of critical importance for regulators to develop and test new approaches. Experimentation and living testing allows regulators to understand and reducing the emerging risk from the new technologies, ensure compliance, and ultimately spur improvement in regulation. There is an increasing need to experiment and exchange ideas and learn from each other. The amplified pace of change pushes regulators to embrace a more proactive approach and ensure that new skill sets are put in place to effectively supervise and regulate. A digital innovation hub, accelerator, innovation facilitator, and regulator sandbox are all the testing laboratories that Consob has recently developed to facilitate interaction and partnership within the financial ecosystem. The second aspect is the transversal approach. In this case, I would propose a way to reorganize regulators to work within, for example, an hub-and-spoke system that focuses on activity-based regulation, replacing the more traditional entity-based remits. The transversal approach, I believe, is at the center of a true collaborative and thus innovative approach to regulation. I mean a regulator akin to sharing information and experience across boundaries and well-defined parameters. Doing so requires a new collaborative approach to regulation, where regulators not only engage proactively with industry participants and vice versa, but also collaborate with the other regulator agencies. We will need to break down the system of silos and barriers that at present are created between specialized regulatory agencies. This will also require changes in the way regulators work. I think that the regulators will have a significant role to play in the future, and that such a role will be strengthened only if a complementariness and transversal approach across agencies gets embedded in both processes and actions. Establishing complementary knowledge and the capabilities at the national as well as at the international level to tackle the thorniest problems we face today will inspire trust in those we serve. Using an international regulatory framework to address the problem of the growth and the development of the cryptocurrency in the market is one such problem to be tackled. My third and the last point is a proposition within the G20 summit. In 2009, the G20 leaders agreed to set up the Financial Inclusion Expert Group and acknowledge a set of core values for sustainable economic activity. In 2016, the technical team of the Global Partnership for Financial Inclusion launched the high-level principle for digital financial inclusion. I am going to propose a further step in this process. I have been talking up till now about the new role of a regulatory framework, and how this role is the cornerstone in the innovative development. In so doing, regulation may therefore transcend traditional boundaries and expand their mandate to incorporate financial inclusion and sustainability. As we have experienced, the COVID-19 pandemic has unleashed a twin global crisis, a health crisis and an economic crisis from which we are just emerging after a longer period. Nonetheless, the COVID crisis has also accelerated the trend towards a more sustainable approach to investing and strengthened the need to connect sustainability and the digital and the financial inclusion. This conference has the aim to get underway the dialogue across boundaries, across agencies and across players, in order to address the most significant problem through a collaborative approach to regulation. And this is because we strongly believe in a more intersectorial approach to financial market regulation. I would like, therefore, to propose that this conference be an opportunity to reflect on the need to launch a new international conference of financial and monetary issues, and to proactively take charge and regulate technological innovation under the aegis of a sustainable and inclusive finance for all. Thank you. Francesca, grazie. Francesca.
Okay, good morning. Good morning to everyone. My name is Francesca Medda, and I work in Consob, the financial authority here in Italy, but I'm also the director of the Institute of Finance and Technology at the UCL, so University College London. So today I would like to welcome all of you, but above all, I'm the chair of this first session of the conference dedicated to the role of the regulator, and the role of the regulator as experimental regulator. So first of all, I would like to introduce the speaker of this session. We have two speakers here and two speakers in remote. So let's see if we can connect with the speaker in remote first. So the first speaker is Sheikh Abdullah Saud Al Thani. Good morning. Hello.
Good morning.
His Excellency.
Good morning.
Okay, so Sheikh Abdullah bin Saud Al Thani is the governor of the Qatar Central Bank. Good morning, and thank you so much to be with us. The second speaker in remote is Ulrich Bindenseel. Good morning. Hello, Ulrich. Yes?
Good morning, Francesca.
So Ulrich is the Director General for Market Infrastructure and Payment, European Central Bank. And then we have two guests here in presence. So Sultana Begun, Special Advisor, RDI, Bank of England. Thank you so much.
Good morning. Thank you for having me.
And Franco Frattini, Vice President of the Italian Council of State. President Frattini, you have to come here. We want you. We left you the chair.
Thank you.
Surrounded by women.
Thank you very much. Good morning. Thanks very much for inviting me. I'll try to contribute as Vice President of the Council of State to this excellence initiative organized by the President of Consob and Consob. I welcome the presence here of President Professor Savona, whom I know for a very long time, and so I'm very happy to see here in this very important room for us and I will be contributing later because, as you know, I will be listening to the other speakers. I'll have to leave the room for 15 minutes a bit later, but well before my speech. Thank you very much.
Okay, you have to speak now.
No.
You are in the session now.
Yeah.
Okay, so we can start.
I'm expected to be the last in the panel. I see the presentation.
Okay.
If you prefer, I also can speak now.
Yes.
I'm absolutely okay. Absolutely.
I will ask you.
Yeah, sure. Absolutely.
Very
as
good.
You prefer. As you
Okay,
prefer.
so good. So we start immediately. This is a session with questions. So I will give a question. And the first question I wanted to ask it to you, Mr. Frattini. So in order to, so we will ask this question first to Mr. Frattini, then I will give the same question to Zoltana and Ulrich, and then I will pass to the second question of best practice to His Excellency. And I wanted to start this first question with a story, just to enter in this context. So, in September 1999, after 10 months of travel and a cost of over 125 million, Mars Climate Orbiter, a robotic space probe, burned and broke into pieces without fulfilling the mission. The problem that was created and why we had this crash was that the space engineers, had used two different systems to measure. One was meters and the other was inches. So why I'm talking in a conference about regulators, something about space? I'm talking about this because I wanted to use as a moral tale and introduce my first question to Mr. Frattini. So we are facing a very tumultuous innovation time with different contexts and changes which require speed and adaptation for us as a regulator. But however, we cannot forget our fundamental values of our mandates, so trust, integrity, access to the norms. So we risk some kind of fragmentation here. And perhaps we may risk the crash, like the Mars probe. So my question to you is, how do we manage the trade-off between speed and adaptation of regulation and our fundamental value of our mandates?
It is a very extremely important problem. We cannot pretend to solve it now, but just to contribute to an ongoing reflection, which is, I would say, already started before the pandemic. We are not talking about a new phenomenon. We can summarize with an expression. I think there is a crisis of law now. The principle of trying to solve every kind of problem by multiplying the legislation, by adding a new integration of the law, by trying to reconcile the need to go fast, because the societies, the communities, the international economics and the markets go much faster than many institutions and many regulators and legislators. I think we have the need that the rules that govern economic activities and services not only are in continuous development and evolution, but also that they have a stronger impact on the essential rights of citizens. And particularly, I think about what the citizens consider essential for the daily life. We have been experiencing during the pandemic a quite new phenomenon. We, the judges of the public powers in this very building, the Council of State, have been experiencing the need to balance between fundamental rights of each and every citizens that are rights protected at the constitutional level. Is the right to health prevailing of the right to education or the right to free movement? So this was an experience that I know because I've been meeting many colleagues in the Supreme Courts of the European Union, the other countries of the European Union, hasn't been solved in the same way. So this is a very first confirmation of the legal system is lagging behind the need to be speed, to be quick, to give rapid responses to the needs of citizens. This is the first element. The second element is that the continuous evolution, which is badly needed, continuous evolution of the legislation, the adaptation to the new emergency and to the new needs of the population requires the legislation for continuous updating. This is another element which is not always here, because unfortunately, multiplication and unclarity of the laws, unclarities of some basic principles contribute to another very negative phenomenon which is perceived by the ordinary citizen, the uncertainty of the legal system, uncertainty of legal provisions. And when there is rights uncertainty, there is, I would say, a degradation of democracy, I would say, because it is not through multiplying and adding not well coordinated law that we can address the problem you raise. How to go faster? You cannot go faster simply by adding a new article, a new phrase, a new principle. You can go faster by having well before a vision. And the vision in this system, when we talk about financial impact of the crisis, for example, financial effects of the COVID pandemic, means to, I would say, understand that the globalization which is needed cannot be denied, cannot regulate itself, should be regulated. So there should be, and what is you are doing, what is Consob is doing in its sector, was Professor Savona in its economic theories years ago explained to us, as a professor, first of all, that it's not simply possible to leave everything to go to its destiny by simply adding a new rule, a new article, a new paragraph. This is the second point. My third point and last point for this first question is that the principle of adaptability of the rules, adaptabilities of, I would say, each and every law to be more easily implementable. This is another element which is a key for the ordinary people. Is it possible to rapidly implement a given law, a given regulation? This is another point, because in many cases, as you know, when the Parliament has adopted a law, we realize that there is a need to adopt 20, 25, 30 adaptation regulation. And many cases, this regulation, the second degree regulation, is not adopted. It happens in Italy very often, not only in Italy, and this gives the clear perception of the difference between what is the law principle and what is the law translated into practice. What is the impact? The impact depends on analyzing before the impact on the destinataries, on the society, on the market, on the companies, and then to make it possible that the law, once translated, has a positive impact. So differences between a theory of law and the practical implementation is the point number 3 I'd like to highlight. I cannot elaborate on all these points, but these are particularly in Italy, in my country that I know the best, of course, the best way to reconcile the two needs. Having a regulation, but this regulation not to be, I would say, incapable to respond to the rapid need of the societies which are in rapid evolution.
Okay, thank you so much. Thank you very much. Ulrike, do you want to add something?
Francesca, actually, I presented some slides, but they are not exactly mapped one-to-one into your questions that you shared beforehand.
Yes.
So I'm not sure at how I should present them.
No,
I mean, tell me.
We can show that your slides maybe during the second questions, okay? So,
Yeah.
Begun, Sultana, do you want to add something to this question? I understand that the question was a little bit complex.
No, yes, perhaps I can carry on from where my esteemed peer actually left off and give you a bit of a regulatory lens to how we go from that regulation into its practicalities. Let me start off by saying the Bank of England works diligently as an independent organisation, and the Prudential Regulatory Authority is the regulatory arm, and we're regulating, just for reference, around 1,500 banks, building societies, credit unions, and insurance. So I think our real aim through supervision is to develop a robust and comprehensive view of firms to really judge whether they're being run in a safe and sound manner. Now, that's important context in a changing world where adaptation and speed of regulation is almost its fundamental value. So we need to think really about how do we keep that safe and sound manner, and whether actually the requirements of regulation, even though they can change, right? They can change outside of our control. We've seen that in recent times. To answer your question, I think we have to really focus supervision on forward-looking, judgment-based, and focus really on the issues and firms that pose the greatest risk to stability. I think the professor said it earlier, it's around us as an organization thinking about how to move forward, how to continue to provide regulation, but also think about us as an organization in being innovative ourselves. So one of the things we do here at the Prudential Regulatory Authority is we actually seek input from our own firms that we regulate to think about us and tell us about the effectiveness and the quality of our supervisory framework. And that's important because the firms that we're regulating are changing, and they are changing at speed from the traditional banks that we know into these digitally enhanced environments. And therefore, speaking to our communities and our firms actually adds to our efficiency in how we do our supervision. And one of the things we do, just as an example, is an annual firm feedback survey. That process is overseen by a team which is wholly independent from our supervisory frontline supervisors. And that really allows us to actually learn and evolve in a responsible manner. And I think that two-way dialogue is very important as we go forward.
Okay, very good, very good. Now we enter to the more the point of this experimental session by asking. I would like to ask a question much more on best practice. So, and I would like to address this question to His Excellency, and then we'll go around again. Okay. So, big data, AI, blockchain. These are just few of the technical innovation that we are facing now. So my question is, what are the practical methods and best practice that you have adopted as regulator to stimulate and support innovation while protecting citizens and environment? So, His Excellency, I leave to you the floor.
Thank you. Good morning. Good morning. Thanks the organizer and also the participant. In Qatar, the central bank has been proactive in encouraging its financial institution to adopt technologies that improve their customer services and operations. The rate of adoption has been high, and the digital transformation of our banks is already substantial and accelerating. When we talk about financial technology, I think it is important to distinguish between two different impacts, both of which offer different opportunity and challenges. First, technology that complement and improve the operation efficiency of institutions, their interaction with customers, and their capacity to improve product delivery and service quality. Second, technology that are often described as disruptive and challenge the established model through which financial services are delivered. Monitoring and assessing risk to financial stability is a core responsibility of a central bank, and that means we want to defend the customers against monopolies, to provide smaller clients with safety and ensure financial stability. Obtaining information on the activity of fintech, new technology, and big tech from traditional statistics and reporting system is difficult. It can be difficult to assess the cost and benefit of a new financial technology, and the lack of data on a new participant added an additional layer of complexity. To ensure the security of citizens while fostering innovation, mean we have to know how much risk does this technology have. We need to give the businesses models of a new fintech a proper assessment, and then we can decide if the fintech response resemble a regulated institution or if we need to expand the regulatory perimeter. Reliable statistics are the first ingredient in any discussion on a regulatory response to financial innovation from a macroprudential perspective. We had struggled in collecting the data to understand the implication of digital innovation because there are hardly any consistent statistics. Many statistics on the financial sector did not capture fintech, as most of these firms were operating as a provider of non-financial services. The activity of these firms were not collected and unknown to make correct assessments. It was even difficult to obtain accurate figures on the total numbers of firms in the market or their market share. We have to close this data gap and took the exercise of understanding and identifying data gap. We are investing heavily in information infrastructure to fully close on the financial technology and technology classification issues. Payment are a key element of innovation, especially as non-traditional payment providers are entering the arena. Many players want to enter the central payment system, and as part of our payment strategy, we have opened up consultation and looked into the legal and regulatory framework to make this happen. There are really only a few options available: ignore, to watch out, regulate passively, regulate actively, or to ban it. How those technologies and are addressed and managed both by financial institution and central bank depend in a large part on the nature of the local market and the expectation and sophistication of consumer. In general, if we feel the innovation cause large-scale damage, then we will ban it. Is the size very small, then we ignore it. If informed decision be taken by the consumer, then caution them. If it cannot be beneficial to many consumer, we passively regulate it. Can it be beneficial to many consumer, but consumer protection issues loom over, then actively regulate it. We felt that e-wallet were very beneficial to many customers. So we took the decision to actively regulate it, have a guideline for it. We will less active in regulating as security become more confidence with the product locally. On the other hand, when cryptocurrencies first started to make headline, based on the request of the bank and their experience in the market, to avoid volatility and uncertainty, the position was taken with our banks was to not be involved with them in a very early stages. For e-wallet, our concern was on how do we keep them safe to use and how can we manage this risk. For this, we expand our regulatory parameters as payment innovation is rapidly increasing. Thus, we issued regulation and guideline on this topic with a specific licensing requirement. For safety, we looked at them as any digital product that face cybersecurity or cyber risk and other technology risks, so standards are expected from the provider. Wallet hold customers' cash that is used for day-to-day payment as per our assessment and had to be very liquid. Our regulation were custom made for them regarding safeguarding money and liquidity requirement as other present regulation could not fit this type of regulation. We want to match the business model of the wallet and to ensure we are not stifling their business model by letting them follow banking regulation. For safeguarding customers' money, options for the wallet were giving such a depositing with a bank. With regard to managing the risk that e-wallet give to the financial system, this is a more holistic view that we hold with payment. The key risk is money laundering and terrorist financing. And the balance that we have to strike is to allow new e-wallet business to start quickly, but also ensure that EML safety risks are managed before they get too large. In this context, KYC continue to be a key requirement, much like any other bank. We have taken a great care in setting up for a new innovation and arrangement at the promoting and organized application of a new technology. Thus, arrangement takes the form of what is known as an innovation hub and a regulatory sandbox. We create the Qatar Financial Technology Hub, which allow new companies and innovation to register in Qatar. The hub provides support and guidance to innovate firms or products, whether a local or international, to facilitate a good understanding of a regulatory requirement. Along with this, we set up with the central bank a regulatory sandbox that allow the risk associated with the new businesses model to be assessed in a controlled environment and to assess whether consumer would be adequately protected in using a new application, product, or services. We have had to adjust the regulatory parameter when we felt our regulation is not adequate. Specific licensing and conduct of businesses requirements have been established for several activities, mainly in payment. In most cases, regulatory requirements focus on consumer and investors' protection, in particularly the safeguarding of customers' funds, anti-money laundering, and combating the financing of terrorists, and on operational resilience. We generally aim to be technology neutral. In most cases, our policies are focused on limiting the potential risk associated with the use of the technology. For example, with the increased use of cloud computing, we work with the banks to control and manage the operational risk involved. For other technology, we issue guidelines and underlying the risk arising from the inadequate handling of personal data, poor governance, lack of transparencies, and unethical behavior. The growing diversity of financial services providers and business model is requiring us to expand the regulatory perimeter. The challenge for us is the day-to-day supervision. For additional vertically integrated bank, it is clear where responsibility lies for the financial soundnesses, cybersecurity, and consumer impact of a product. When the financial service value chain is spread across different layers with, for example, one holding the customer's relationship, another holding the customer's fund, a third providing data analytical and deciding which customer gets services, and the fourth providing technology infrastructure. It is more difficult to pin down responsibility for error and mistake and to ensure that consumer interests are protected. This is now causing us a complex trade-off between three categories of policy goals. These are financial stability and market integrity, efficiency and competition, data privacy, and consumer protection. With respect to any initiative that introduce more disruptive technology, it is probably correct to say that we are proceeding more cautiously. While we can appreciate the value and necessity of the creative distraction, that innovation drives the idea of creative distraction will generally get a cautious reaction from central bankers. A reaction that will emphasize the benefit of a gradual, well-managed process of the change designed to preserve trust and confidence in the system. Because those are the attributes of banking and financial services that make them work. There is an old saying that trust lives in a horse and returns in foot. When consumer and depositors lose trust in financial institutions and the system, the effect can be long-lasting and devastating. Thank you very much.
Thank you very much. Thank you so much. It was very interesting to understand the situation in Qatar. I will shift now to the other speaker, Ulrich. It's fine for you to answer these questions? Let's see.
Yeah, thank you, Francesca. And I would then also quickly present my slides, if you allow.
Yes.
Yeah. Okay. So now you should see my slides. So
exactly, we can see it perfectly. Thank you.
Excellent, thanks. So I approach the topic in a quite broader way. I mean, starting from the fact that the Euro system, the ECB, is not only a regulator, but also a policy institution. And here, just as a reminder, are the 4 tasks according to the ECB mandate. So monetary policy, foreign exchange, foreign currency management, and promoting the smooth operation of a payment system. And of course, we face a changing environment on all of those tasks we have. And here just climate change, globalization, digitalization, and COVID-19 as 4 major ones. And let me say a few words on maybe something that is particularly remote to regulation, but very much at the core of the ECB's mandate. That's the monetary policy and the changes of the strategy that were just announced after extensive work on the topic. So to move to a symmetric inflation target of 2%, to make certain changes to the definition of the consumer price index, namely including owner-occupied housing, and to integrate climate change into the strategy and to have an action plan there. I will explain a bit further. And here, I mean, this is a change that you could say reflects actually a long-term trend that was even observed since the 80s, but somehow was maybe fully understood or fully materialized only in recent years. Namely, that's the trend to low inflation rates and the low inflation expectations that brought the so-called zero lower bound problem to the forefront. That monetary policy was restricted by not being able indeed to go really negative, and therefore the very conservative close to but below inflation target required this adjustment, which was maybe the core point on the left side of this change. On climate change, let me say a few words on climate change, which gets a lot of attention from policy makers as a major change of the environment requiring a reaction of policymakers and regulators. And we have defined this action plan according to, let's say, 3 steps: data, knowledge, and action. So, of course, to collect data from banks on their assets, carbon footprints, and to enhance our macroeconomic models to understand better the effects of climate change. And talking about knowledge, here are a range of activities we have done and will do. So there has been, for the first time, an economy-wide climate stress test in the euro area done in 2021. Press release just made in September. And this was a very granular exercise looking at the really balance sheets of firms. I mean, using all the data we have on individual activities and exposures of firms and the financial system, and coming to the conclusion that the costs of climate change would be far greater than the costs of the green transition. We will in 2022 stress test also our own balance sheet to identify climate change. There will be supervisory climate stress tests of individual banks in 2022. There will be climate-related disclosure requirements for private sector assets, which we would continue to use as collateral in monetary policy operations and in our asset purchase programs. This is really to be worked out. Further details to come in 2022. And we will analyze how rating agencies include climate risks. And then, of course, action has to follow. And one point that has been announced already is to include climate risk in the collateral framework and to move forward on disclosing requirements. On the side of market infrastructure and payments, and that's my own area of responsibility, we are really there in 3 functions. So we play a central role in developing, operating, and overseeing market infrastructures to facilitate the safe and efficient flow of payment security and collateral in the euro area. We also act there as a catalyst and look in general for modernization. And just 1 or 2 slides on our own infrastructures we are running. I mean, the first 2 are really wholesale infrastructures. T2, our RTGS system, and T2S, the security settlement system used in the entire euro area and also beyond, and the instant payment system, which is, I would say, at the core of our retail payment strategy to extend the use of instant payments. And here we also offer our own system, which, however, is in competition with private instant payment systems. And that's maybe just our major project at the moment. It is the consolidation of Target 2 and Target 2 securities and the modernization of our RTGS system. But maybe more interesting in the context of this conference is our retail payment strategy. And here, of course, as Sheikh Abdullah also has explained very interestingly, there's of course a lot going on, and really the central bank in need for reacting both as an overseer, regulator, and maybe a provider of its own solution. So here we have in the euro area, moreover, the interesting issue that in the last decade, international credit card schemes have gained more and more market share. E-commerce has seen also, let's say, international firms taking a larger market share, European solutions remaining fragmented and losing market share over time. And one vision in our retail payment strategy is the deployment of instant payments as a new basis for retail payments, as it is already the case in a few countries like the Netherlands and Spain, but on a pan-European basis, to regain also the role of solutions under European governance for strategic reasons. And the biggest maybe concrete project now, which will also change the retail payment ecosystem if it goes live, is the digital euro investigation, the launch of a project decided by the Governing Council on 14th of July 2021, and the idea to be prepared to issue a digital retail payment central bank money in the euro area. As our president is saying, in the digital age, citizens and firms pay digitally and want to be able to do so, presumably also using the safest form of money, central bank money. This investigation phase will last 2 years and will basically work out the functional design and functional requirements of a digital euro. And the big factors, let's say, triggering the interests of central banks and the ECB in particular is the declining use of cash, certainly. So the form of central bank money available to everyone finds less interest, but we want to preserve the ability of citizens to use central bank money, moreover to support the digitalization in the European economy and tackling sovereignty concerns that I have already mentioned. So we want to tackle them on one side by encouraging private pan-European solution, relying ideally on instant payments, but also, be prepared to issue CBDC also from this perspective. And we did experimentation. This is now not experimentation as regulator, but experimentation in a technical sense on different features of a digital euro that we have already done even before the investigation phase of the project. So we have tested different ledger constructions, so distributed ledgers and central ledgers, including infrastructure we already have for the ability to run a very high amount of transactions. We have looked at privacy and anti-money laundering. Both are, of course, very relevant and need to be combined. We considered limits in circulations, how we could impose them, and how the end user would access what type of devices should be prepared. And there are a number of key questions really that also have to work out in how the digital euro would interact with the current ecosystem. How would the various players in the current ecosystem want to actively promote its adoption and use? On one side, they may perceive it as a competitor. On the other side, they should see it as a chance to distribute this new form of digital currency and be part of this ecosystem. And there are various trade-offs which need to be understood better. So that is truly innovative thinking we have to, land. On one side, we want to minimize industry investment costs for supporting and implementing the digital euro. We don't want to produce undue dependence on the industry at the same time and not give undue preference to certain providers. We want to offer a distinct value proposition that users recognize, that the consumer is keen then to have. And we don't want to crowd out private initiatives. We want to coexist. And we have to find solutions which, find a point in this trade-off on the efficient frontier, if you want, and balancing the trade-offs. And finally, we have legal requirements, and that is also interesting. If you have a relatively short time horizon in which you want to prepare such a project, you need, clarification from the EU legislator on a number of points. So just to give you one example, anti-money laundering directive. The basic assumption is, of course, that this would also apply to a digital central bank money, so to the digital euro. But, maybe the legislator wants to fine-tune certain aspects and to apply certain aspects in a different manner to the digital euro. So, we have to bring together those views of the legislator and the project, such as to be able to issue digital euro, if this is decided, within a reasonable number of years. So there are lots of complex interactions that have to be managed in close collaboration. And we have a contact group with the EU Commission, which aims at exchanging views and being prepared for this smooth collaboration also on the legislative side. Thank you very much. That would be all from my side for now.
So thank you so much, Ulrich. So I can see a line, first of all, problems with the data, with the innovation, but also really the regulator more proactive and ready to see the innovation. I will leave the floor first to Sholtana because she's an advisor on RDI. So in the Bank of England, what is the best practice?
Yeah, I mean, so it was a really interesting question when I got it, Francesca, because I thought about it in two different ways. I thought about actually us as an organization, how is the Bank of England doing innovation, and actually how do we do that in a way that is safe and sound and protects its citizens? So I think it's safe to say that the financial services sector is being revolutionized by data-driven technology. And I think His Excellency already mentioned the issues around data gaps, and that is certainly something that we're looking forward to in our Future of Finance response back in 2019. We actually commissioned a whole new work stream on the future of data collection, and that goes from everything to minimizing the burden on industry, but also ensuring that we get the right data in order to make the decisions that keep us safe and sound. I think digital banking, blockchain, artificial intelligence, we've heard it a lot, and it is reshaping traditional financial services. And as a result, financial institutions, including us as regulators, are seeing the emergence also of ethics in public debate. So here at the Bank of England, we are committed to promoting responsible innovation. And one of the ways we're doing that is, as mentioned by my ECB peer, is the central bank is looking to harness that innovation through central bank digital currencies. It really shows the important role of public institutions, but actually also the private sector in moving forward. International cooperation is also really important in addressing new issues that arise, particularly those which are cross-border. And as technological advances are increasing, it means that innovations are fast becoming borderless. Central banks have been researching CBDCs for a while now, focusing on how they may impact their mandates to preserve and maintain monetary and financial stability. I think a core feature of a central bank digital currency is that it is issued by a public institution and would intend to, for all purposes, be the safest form of money possible. I think a recent survey done here by the official monetary institution here in the UK suggested that both as a monetary service provider generally and for digital currency specifically, that central banks were actually the most trusted, followed by payment services providers, and interestingly, major technology companies who are doing it already were the least trusted. I think it's also important that we think about the private sector involvement in the user-facing aspects of a CBDC. I think using private sector will help anticipate the needs of future users and act as a platform for private sector innovation. If I think about the G7, I know that's recently published a set of principles, actually, considering a number of public policy issues, including privacy, competition, avoiding illicit finance, energy and environment, and financial inclusion. It also reiterates that the G7's view that any CBDC that is issued should be grounded in long-standing G7 public commitments to transparency, the rule of law, and sound economic governance. Another thing that we kind of think about, actually, is stablecoins. In terms of best practice for innovation, the G7, which the UK holds presidency for this year, has also stated their commitment to continued coordination and cooperation to ensure that innovation of private digital money and payments remains responsible, safe, and consistent with our shared policy objectives. I think this further highlights the importance of international cooperation to consider cross-border issues in the interest of our citizens. As an example, there is ongoing work which is coordinated by the Financial Stability Board, working with setting bodies to identify and address the potential gaps of overlaps to encourage all entities to perform relevant functions in relation to or in support of stablecoin arrangement. I'd like to tell you a little bit about the Bank of England's Artificial Intelligence and Public-Private Forum, changing the subject slightly. So many of you will know that in times of unprecedented economic turmoil, business commentators will often predict that financial firms will deprioritize long-term technology projects, which don't have any immediate cash flow benefits to the business. To help us understand the impact of COVID AI, machine learning, and data science in the UK banking sector, we actually conducted a survey of all our regulated banks in 2020. And that survey focused on the bank's perception of things like machine learning, data science, algorithmic trading, and resourcing of current machine learning initiatives. During the pandemic, there were both speculations and publications in the media surrounding the adoption of AI during a crisis. However, our survey found that 40% of respondents actually reported an increase in the importance of machine learning and data science for future operations. And a further 10% of banks actually reported a significant increase, so much different than what we speculated. More noticeably, none of our banks actually reported a decrease in the importance they played on things like machine learning, AI, and data science. The other things that our kind of forum found out really was we worked with the industry to share information and understand the practical challenges of using things like AI within financial services. We also worked with industry to look at the barriers to deployment and the potential risks. I think we all know that there is lots to be gained from using these type of technologies, but as central banks and regulators, we need to know that where should we provide guidance on regulation, good practice, and support safe adoption of these technologies. And we should also consider if firms' involvement could be useful and what form it could take. Some of our key findings included things like the speed, complexity, and scale of AI models and the range of data-related challenges means that existing risk management and governance frameworks really need to evolve to cope with them. There's also a need to clarify and clearly define roles and responsibility within firms to ensure accountability. But there is still uncertainty about what good governance actually looks like. There's also, interestingly, a skills gap that exists at all levels which need to be addressed to ensure appropriate risk management, internal and external auditing, governance, and the overall use of AI. While there are actually no AI-specific financial regulations yet, there are existing regulations that apply to the AI use, but the regulatory landscape is fragmented. I think, lastly, I'll add that there are areas of financial regulations are very, very ambiguous and less clear, and further guidance could increase clarity and firms' confidence when deploying these new data and technology solutions for innovation.
Okay, thank you so much. Very, very interesting. We heard from three major central banks. Now I leave the word to you. So that is a jumping, but it will be interesting to hear from the Council of State. What are the best practice?
Yeah. Thank you very much. Following what has been said, I'll have three remarks on this. Since for the first time, the Council of State in the last roughly 2 years have been, I would say, adopting some court rules. It never happened in the past on procedures that can concern even millions of citizens having to do with artificial intelligence within the public administration system. It is a very new phenomenon for Italy, and particularly for the administrative system, the public administration system in Italy, but it has a very strong impact on many rights and many positions, as has been said, of ordinary people as individuals and as communities. My first remark is that no doubts the instruments that have been mentioned, artificial intelligence, robotics, I would say blockchain, have been forcing the traditional business environment and business model to, I would say, change, sweep away from the traditional models, from the traditional way of regulating, and nevertheless, is a matter of fact, they have to do. This, unfortunately, has been a very difficult exercise for the public regulators. This is the point. While the markets, while the business communities have been by nature forced to adapt and to start implementing this new system, much more difficult it has been for the legislator. And so my first point is there is, I would say, a debate, which is not only a debate, I would say it's a challenge between rule-based regulation and process-oriented regulation. This is an element to be taken into consideration because, the changing of markets, the arrival of new players is a challenge, but we cannot bypass. We should address what to do. And this is the second remark. In order to guarantee what I said before, the certainty of the regulatory framework, we have to put together these two needs. The needs to adapt the new legislation, the new regulation, while bearing in mind that we cannot do without considering the new instruments. This is the difficulty. This is the difficulty for the national legislator. This is even more difficult for the public administration. This is the second point, which is, in my view, the key, because the ideal solution is and should be to strike the right balance between keeping the risk under control, the risk of uncontrolled expansion of the new models at the expenses of basic rights of individuals. It has been mentioned the case of privacy protection, but not only these, while, of course, I would say, granting the possibility that the law, the regulation, accompanies the innovation. And while accompanying the innovation, helps, promotes better possibilities for the business community. This is the right balance. Is to strike the right balance is absolutely difficult for a number of reasons that have been said. My third remark is how to do, since it is essential to do. A good way is the final result in our ideal quick result we all wish is that to adapt and develop a new regulatory framework that can support and ensure resilience of innovation. The point of resilience of innovation is one of the key points taken, for example, by the current Italian government led by President Draghi when it decided to establish a ministry for innovation and transition and digitalization and technological transition. But it is not easy. And so how to do? I can imagine, since also our experience to be a judge of public powers called upon to guarantee the rights of citizens before the public authorities, a good idea could be to embrace a more experimental approach, not simply to put and to keep, I would say, a top-down regulatory approach. On the contrary, to move rather towards a more experimentation. The live testing exercise allow the regulators to understand innovations and to reduce the risk of emerging technologies and ensure compliance. What are the risks of emerging authorities? It has been said about privacy, but I would say in European legislation, it has been very often highlighted the risk of voluntary or involuntary, mainly, discriminations between categories. Think about the use of algorithm. Algorithm in use within an administrative procedure can lead to discriminate. I'm against those who believe that the algorithm, the artificial intelligence, is a neutral component. It is not. It depends on what and how is prepared the instrument. And if the instrument is prepared with data that tend to mislead respect to the non-discrimination, to the privacy protection, to the basic rules, the algorithm, the artificial intelligence corresponds to its preparation and can, as we experience in some administrative procedures, prepare with, and thanks to the artificial intelligence, where the high-level officials in the public administration didn't want the risk to contradict the algorithm, to contradict the artificial intelligence instrument. So the experimentation way helps a lot to avoid, to lose control from the human beings that should be always the controllers, the monitoring element for the well-functioning of the artificial intelligence instrument, for example. And my final point, it is not true that experimentation regulation does not exist. I would like to mention an Italian experience, the Italian experience of fintech, you know, much better than me. I'm a judge, but you are expert economists. In the fintech experience, we have this system, which is quite an innovative system. In the same time, is a practical system. We call it regulatory sandbox. They are the main supervisory authorities, and the government, this model gives the possibility to implement and also to strengthen the skills on the part of the administrative authorities that have to manage the experimentation. So a guided experimentation helps the regulatory system to be more flexible, more adaptable, and to be in line of what I consider a key common denominator to prevent the human factor to lose control of the process. This, for a judge, is, of course, a must to guarantee protection for the vulnerable categories. But I think also for the business environment is a good instrument. And the Italian models for experimentation, for introduce in the field of regulatory processes, the experimentation while, I would say, increasing the awareness of the practical impact of the regulation is a very good model, and I thank those that have been invented and start implementing this system.
Okay, thank you so much. It's very interesting because we are moving from the central bank view to the judge view. But I think there is a line that connects all of us, and that is, I think that is interesting. I have to say thanks to this panel, because we have really very different perspectives, but in line with each other. So I will start with my last questions. And last question, I would like to go back to the fact that we are here at the G20, and the Italian presidency of the G20 is based on the 3P, people, planet, and prosperities. But the core of the discussion that has been in these months has been also around 3 Cs, which are the credit, COVID, and climate. And these 3 Cs represent more the risk that we are facing. So we are discussing now, today in this session, about the regulator who needs a clear understanding of the ecosystem where he works, but sometimes she or he requires also to step in outside the usual comfort zone of the regulator. So the traditional regulatory system and supervisory approaches. So now I would like to ask to all of you, starting with Shaltana, because we are in this group, we have only one lady on the panel of 4. So what is the role and particularly your role and your institution? How do you address this challenge? What is your experience as an experimental regulator?
Thank you, Francesca. I think, let me try and focus on some of the C's and some of the P's that you mentioned. I think our objective as a central bank of the United Kingdom is to play a leading role, actually, through our policies and operations in ensuring that the financial system and also the macroeconomy and the Bank of England itself is resilient to the risks from climate change and also supportive of the transition to the net zero economy. I think it's safe to say we've all been through a year like no other in recent history. And whilst COVID-19 pandemic has put our health and our economic systems under enormous pressure, our environmental systems were actually afforded a brief respite. But as we look ahead to the year marked by vaccinations and economic recovery, that respite may prove to be very short-lived. It is therefore imperative that consumers, businesses, investors, our policymakers, in fact our entire ecosystem, make really informed choices that put us on a path to net zero through a green recovery. There are many challenges to solve to make this happen, but effective and widespread climate disclosures across the economy is an essential ingredient for success. I think to a certain extent, many central banks are actually experimenting in this space with new demands. We actually have become the first central bank to propose greening a monetary policy portfolio and have committed to reducing emissions from our own physical operations to net zero by 2050 at the latest. I'm very proud to say this. But as a special advisor to innovation, stepping out of my comfort zone is always something I'm open to, but with caution. As an organization, we understand that climate risks have a direct impact on the delivery of the bank's core policy objectives, and so actually have driven a range of policy actions to build resilience across our financial system. The importance of this work has actually been recognized by the government in updates to the remits and recommendations of all three of our bank's policy committees. For example, noting the government's economic strategy, which the committees have regard to includes structural reform to transition to an environmentally sustainable and resilient net zero economy, and maintaining a financial system that supports the transition to a net zero economy. Climate journey is a journey we're all actually in together, and I hope we can work collaboratively with our counterparts to address the climate change challenges of our economy. Finally, as a leader in the space of innovation within regulation, I was delighted to see the Bank of England's work actually recognized through the Green Initiative Award from Central Banking. Some of the other climate strategies built around 5 key goals, which I'll end with. Ensuring the financial system is resilient to climate-related financial risks, supporting an orderly economy-wide transition to net zero emissions, promoting adoption of effective TSD-aligned climate disclosure, contributing and coordinating international approach to climate change, and demonstrating best practice through our own operations. On the 9th of September, we actually announced the registration open for a joint research conference with Banca d'Italia itself, and on the microfinancial impacts of climate change and the net zero transition. And I welcome the start of this piece of work.
Thank you so much. Thank you very much. I will shift immediately to His Excellency, because we are passing from the advisor of RDI, so you should be an experimental, to the governor of central bank. So stepping out from your role and be outside your comfort zone maybe could be more complex. So Your Excellency, I will leave the floor to you. I lost the connection.
It's okay now? Thank you.
Yeah, I can hear you, but I cannot see you. Okay, perfect.
That's
Oh,
okay.
fantastic.
Thanks. Well, thank you. The 3 C's are presently extremely important area of focus for the Qatar Central Bank. And without trying to prompt controversy, I would add a 4th C, cybersecurity. I would like to quickly address your comment on the central bank stepping out of the comfort zone and taking a proactive role. The role of the central banks continue to expand. It is interesting to note that with the central bank, their original function as it is emerged during the 2nd century, ending in the early 1900s, was usually to hold the monopoly on the issue of legal tender. Central bank money soon became the natural means of settlement for interbank transaction. As payment evolved and commercial banks were a counterparty to payment transaction, central bank function evolved to monetary stability through money supply regulation and monitoring bank solvency. The essential became what is in the modern day is known as a financial stability. Central bank had a mandate that embedded a financial stability dimension although it was not explicit. Today, price stability and financial stability are expected from a central bank while maintaining independence from the government and parliament. Now, you mention a whole set of new challenges. To do so, we are clear about it. We at Qatar Central Bank do not stick to a narrow defined price stability mandate, and we do not allocate other duties such financial stability responsibility, such as bank supervision, to a different agency. Over the last decade or so, we have been reminded forcefully of the effect of our interconnected and interdependent global economy. This interconnection and interdependency have led to incredible opportunity, but also to an unexpected vulnerability. We have been working with our government for some years now to maintain our independency and create the right tools to contain emerging macro financial risk. We have embraced the challenge that have come upon us and incorporated stability and growth along with our monetary policy function. We, as a central bank, have taken on the macroprudential function and play a large part in the microprudential. This ability to go beyond the normal of central bank allowed us to play the pivotal roles in Qatar effectively, having a smooth process in COVID. We provided support of nearly 5% of GDP in credit support through liquidity facility, lowered interest rate, provide support to all borrowers in the country through freezing of payment, offered guarantee on loan, and worked closely with the government in setting policy in a place to go through this tough period. Some of the data with regard to this is on the chart on the screen. The role has expanded now toward prioritizing the adoption of sustainable agenda, and this goes beyond moving businesses and consumers to adopt practice that prompt resilience and good governance. One of the reasons we are forced into outside the normal duty of central bank is because of the ecosystem we are in. Qatar is largely dependent on hydrocarbons, and it has contributed largely to the country's economy, and it is important for us to realize that this asset Qatar has need to be protected and realize the risk it may give to the state from a reputation and sustainable point of view. The past 6 years have been the warmest on the record for our planet. The number of disasters caused by natural hazard is rising, resulting in hundreds of billions of dollars of damage in 2020 alone. The human-induced global warming has resulted in these events becoming increasingly severe. The environmental challenge in Qatar cannot be answered without data. With regard to green or sustainable finance, for us to move forward and tackle this problem, our efforts were being hampered by data gaps, as collecting data for climate risk and sustainable or green finance within the industrial was non-existent. For instance, we could not assess the financing position of the industrial of different types of loan, if any were green and on much higher level. We could not assess fully the operational impact of borrowing on climate. We have decided to go on a total renovation. This topic is important to us as a state and as a region. As the charts show, green bond issuance are flying globally, as well as different type of sustainability bond. As a whole, Overall debt issuance in the Middle East and North Africa has been increasing due to declining oil revenue and increasing pressures on government finance. With debt becoming the new normal in the region, I believe it is neutral that shift should move to a green. The growth potential of green bond makes in the Middle East and North Africa is high as economic diversification and the transition to clean energy accelerated. Investment in the renewable energy projects in the region has been robust, including several large-scale of solar projects and water treatment and desalination projects. The meeting between green finance and Islamic finance continue to attract interest from domestic and institutional investors. Given the focus on sustainable development, the development of guidelines and standards for green finance can be adopted for Islamic finance instrument. We are in the process of joining the network for greening the financial system to get the technical capacity to move ahead with this vision. While this is happening, we are setting in motion new sustainable finance policies and action that could potentially overhaul the way banks do business, but we feel is necessarily as we see the ecosystem we operate in and the challenge that are emerging. This includes a new ECG reporting and disclosure principle, a methodology for rating our banks on their loans with regard to sustainability, a sustainable finance framework, and guidance on issuing a green bond. Finally, in response to your question on addressing the set of challenge and setting out of the comfort zone, stepping out of the comfort zone sometimes requires making people unhappy, specifically the industrial for the sake of the people, especially considering the ecosystem we work in. Qatar is home to many foreign national and immigrant workers who send money back to their home country frequently. If we can make cross-border remittance cheaper and faster, our migrant workers can provide better and more timely support for their family. Traditionally, for many of these workers, making payment abroad used to be slow, costly, and inefficient. We are continually working with the technology providers to make an even playing field for payment, as well laying down the infrastructure to even the playing field. Identifying the area that optimizing the risk we are facing is critical to identifying trouble ahead and being prepared to require a broad view of the global and domestic factors that affect growth and stability. And while this is accepted wisdom, event over the last decade increasingly emphasized that we need an even wider view than we have previously thought necessary. A wider view that extended beyond the learned behavior of historical, financial, and economic modeling to a deeper understanding of the effect of positive and negative that globalization and the interconnectivities of our destinies give rise to. A view that challenges us not just to avoid repeating past mistakes, but to anticipate the new challenges arising from new sources of risk that inevitably await us as we strive for a sustainable growth and a stable environment in which deliver that growth. This wider view requires us not just to step outside of our comfort zone, but to accept perhaps that there cannot be a comfort zone. We need to search for the unexpected and from non-traditional sources of risk. Thank you.
Thank you so much. Thank you so much, His Excellency. So we are talking about stepping out comfort zone. So I pass the question to a judge. How a judge can be outside the comfort zone?
Frankly speaking, having listened to the two previous speakers, I have in mind some reflections that can run the risk to be provocative. But I think since we are talking about, you asked a question mentioning G20's role, the role of international community, the two speakers talked about macro-financial risks, economic stability, environmental stability. Very well. My remarks are not as a judge remark. It wouldn't be possible. But I have in mind a point where the international community has been practically always very reluctant. I have in mind the many attempts since the time when, as Italian foreign minister, I've tried, together with others, even to address the topic of what we called at that time global legal standards. So I'm talking about a point that is a matter of fact. Economy is for sure global in rules, and this is why it has been mentioned, the point of addressing microfinancial risks, for example. But as a legal expert, if I look at the regulatory system which are in the world, I find more than 100, mainly more than 200 different regulatory global system and roughly 100 of supranational quasi-judicial bodies. Is that a contradiction? Is there a contradiction between the reaffirmed goodwill of each and every important player, states, for example, and first of all, global players, states that play a role on international scene, those states that will be attending to the G20 this year under Italian presidency, is there a contradiction between these continuous reaffirmation of globality of the risks, need of globality of responses from the environment to microfinancial risk, and the reluctant even to address the possibility of the legal regulatory system to evolve towards global legal standards that help contribute making, I would say, more just and more transparent the system of interconnected regulations in the world. Is there a contradiction? Well, I'm not naive. I understand very well the reasons why there are so different models of regulation. But the COVID-19, the pandemic, no doubts, is imposing to us, to those who are the judges, as to those who are managing the processes in global economies, to at least think about rewrite some rules and some principles? Is that a good opportunity to try to think about globality in terms of rules, not globality, which is a matter of fact, in terms of challenges? This is an open question because I'm not sure. I'm very pessimistic on the fact that already in the incoming G20 summit, there will be some concrete decision. You know much better than me what has been the outcome of the G7 in UK. It has been a first step, full of good intention, full of goodwill. But what about the real concrete initiatives to try to move to the evolution of the regulatory system towards a more globalized approach to the regulation? I'm not naive, I repeat, and so I think the G20 has, in the same time, a challenge and an opportunity. Many of those who are advocating in words, including the global business system, to, I would say, for example, coming closer to some globality in regulation in practical terms, prefer the status quo. It's maybe too pessimistic analysis, but now we have financial stability as a real global challenge, but if I can, we have even more. We have to face a human challenge, an anthropological challenge, which is leading to aggravating the feeling of frustration and to be forgotten in millions and maybe billions of ordinary people in all the 5 continents. Is that something we could address by having in mind as our political, it's your duty, not my duty, it's the politics' duty, having in mind as a political goal to try to find a response to the injustice which is in the environmental crisis, in the, no doubt, existing more serious imbalances that we can note, we can testify in many countries in the world, from the healthcare. What about the imbalances in the vaccination supplies? Is there a component imposing global regulatory solution and not only to repeat, there is a global challenge, there is a global problem, we have a problem to face together. How? If not with a common system, principles that have as a center the human being. Frankly speaking, I'm not an economist. You know much better than me. Maybe I'm mistaken. I'm simply one having the responsibility to try to mitigate the injustice with my decision, with the court rulings. But I cannot escape from putting on the table a reflection. A reflection on this is possibility that also the component of global economy are involved by the evolution process, which has been reaffirmed in words, but not in deeds. Is that a provocation? Maybe it is. It is possible to guarantee with some common legal standards, because it is very easy to say, okay, we have a voluntary principles that the goodwill countries will implement. It is not enough, in my view. It is possible, and is an open question, to overcome the current imbalances. I repeat, because is the drama of today, to grant access to all supplies. I'm not talking about only vaccines. I'm talking about all supplies, all the supply chains in all the regions of the world, by trying to approximate or to find an agreement on how to evolve towards binding rules that will be not matter of tomorrow or the day after tomorrow. But if even we forget that this is a problem for the regulators, for the economics, for the, I would say, promoters of more just and fair societies, it is applicable also to the field of environment. How is it possible simply to say, okay, this or that corporate has decided to revert partially an amount of money to contribute, within brackets, again, on a voluntary basis, as a gesture of goodwill? Is it enough? It's not enough, in my view. This is my provocation. This is my concluding remark. When we are talking about G20, not to say about G7, frankly speaking, even though Italy is one of the very few members, if we talk about G20, the legitimation of supranational bodies that pretended to represent the whole of the world, can they represent now the whole of the world while not addressing these elements that affect the parts of the world that are not at all represented within the G20? Think about Africa, only one country. Think about the Muslim world, more than 1 billion of people. Yes, Saudi Arabia, and that's all. Can G20 really have the ambition to represent the needs of billions and billions of ordinary people without putting on the table the need of globality only in standards, in economic rules? Not tomorrow, but the need just to evolve towards that direction. I think this would give G20 more legitimation, not before the elites in the world, before the ordinary people that are very often the vulnerable victims of discussions that are taken in another place of the world. This is the reality. I understand it's not diplomatic at all. I used to be the Minister of Foreign Affairs, but I can run the risk to be not diplomatic at all now that I'm simply a judge. Thank you very much.
Thank you so much. Thank you so much. I have to say this. We have the Qatar central the bank, but also I wanted to add he was invited in this panel also the Central Bank of Kenya, that unfortunately due to the COVID was not able, the governor, to be with us. So, but in some way this was an open beyond the G20 country. However, the last question and the provocation goes to you, Ulrich, who represent the European Central Bank. So more, let's see how you take this provocation.
No, I don't feel provoked. It was very good, really, to listen to Mr. Fattini, and I'm sorry that from his very broad approach and conceptual reflections, I would turn again to a more narrow, specific topic, which would, take up the G20 presidency and the topic of cross-border payments and the role here of the regulator. And I think here we are in a certain way outside the comfort zone, because by definition, cross-border payment doesn't work without international collaboration and the setting of standards. And this is, of course, one dimension more complex than any domestic regulation. And it's a fascinating topic. So the G20 has launched 19 work streams to progress under the IOSCO and the CPMI. And, I think one starting point was that despite the tremendous improvement of technology, of ability to communicate internationally, where you can have a quasi cost-free WhatsApp video call for hours between Germany and Australia, you have seen that cross-border payments have not really become cheaper over the last 15 years, just a little bit, but not, what you would have expected at all. And one of the reasons is certainly also regulation. No, I mean, the certainly necessary AML regulation, related regulation, the compliance costs of banks, the perceived legal risks have led to a de-risking, that banks have withdrawn from this activity, and this has reduced competition and has contributed together both the higher costs, the higher risks, and the lower competition to those costs not really decreasing, although they should, if you look at the tremendous progress in technology. So first of all, here, regulators have a homework to do. They have to work on making compliance more efficient for the industry by, let's say, reducing legal uncertainty, by reducing heterogeneity of implementation of regulation, as a major contribution, in my view, to renewed efficiency and competition in this area. So, I mean, the regulation in this field is necessary, it is well meant, but it contributed to costs and to an unfortunate reduction of competition. And then, of course, new players coming in. And those new players, we have seen the big promises of certain big tech firms who offered basically or announced to come in the market with global stablecoins, which would solve all problems of international payments. But of course, those have to be subject to the same rules. And here I think the international regulatory community was successful in reacting very quickly to this emergence of stablecoin providers and making clear that they have to be subject to the same regulation under the principle of, let's say, one activity, one risk, one set of rules. So there, I think the regulators were effective. Less effective, I think, and here this is really outside the comfort zone, is on Bitcoin, where in some countries, as we have heard, those have just been forbidden, which is an effective approach, of course. But other countries see are more ambiguous in considering this may be a useful innovation in some areas, but clearly Bitcoin also raises a lot of risks, no, on the side of consumer protection. The ongoing speculative, let's say, bubble or not bubble is in any case risky for consumers, no? We have seen a new record prices of Bitcoin last week, and some believe it's a suitable investment class. But is it really, what is the steady state? What are the rates of returns? There are lots of question marks. And here the regulators have been quite slow to make up their mind because Bitcoin is so different. And the same in the area of AML compliance, no? I mean, there has been this significant effort to have AML effective at an international scale with the, let's say, costs that I had mentioned and the need to improve. And, high fines have been applied to banks. Banks have been closed. Banks have very high costs. At the same time, that Bitcoin is used for illicit payments has been known for a long time. And not so much has happened there. There is now, of course, it has been identified that you can, of course, put the wallet services provider, so service providers who intermediate between the Bitcoin network and the consumers who don't want to access the Bitcoin network in its original intention directly, those can be regulated. And there are now regulations in the pipeline which would make all those service providers similarly subject to AML CFT regulation. And this is fine and is logical and should progress. But of course, the Bitcoin network can also be accessed directly. There's no strict necessity to use intermediaries. And here, regulators have been so because it's such a different animal. And my sense is there was a bit the feeling this is not possible to regulate. So very little happened. And here, of course, the idea that one function, one activity, one risk, one set of rules is not implemented, is not, there's no forceful activity to close this gap, that on one side the regulated industry is really, subject to this at high costs. The new industry promising to do those things better, like stable coins, is it's made clear to them you have to do this as well. The service providers in the, let's say, crypto asset and Bitcoin universe are also put subject to this, but the network itself is still considered to be out of scope. But the fact is that it can be used. The big guys, the big bad guys will use it directly, will not go via service providers. So this is a true challenge to regulators, and this should be taken up in the future, and is a good example, I think, where regulators are out of the comfort zone and may move relatively slowly because of that.
Okay, so thank you so much. I think we had a very interesting session because we start to see that there are also the intention to create a connection across us and across also different entities. So I would like to thank first of all our guest, our speaker from remote, Ulrich Bindesee from the European Central Bank. Thank you so much. Sheikh Abdullah bin Saud Al Thani from the Central Bank of Qatar. Thank you so much. You have been very interesting. All the presentation. We hope that we can really go another step from G20. But here from the Bank of England, Sultana Begum, and Vice President Franco Frattini from the Council of States. Thank you so very much to all of you and to all the audience here and in remote. Thank you.
Thank you.
Bye-bye, thank you.
Thank you, Tom.
Pardon? So, good afternoon. Welcome to this afternoon session. Our session is about digital innovation, growth, inclusion, and disruption. I think President Savona this morning said how to square the circle, if I remember well. Now, squaring this circle, maybe it's even more complicated than the ordinary circle. We are introducing another element, inclusion, into the ordinary disruptive, accelerated elements of innovation for growth. Now, how to do this? It will be quite a responsibility for an afternoon session to keep people, let's say, on the brink, on the one hand, at the same time staying on the ball, which is staying in practice. We will move into details in the sense of business details, research details, and why not also regulatory details. And we do this thanks to the Italian State Council in Palazzo Spada, which is somehow for us a continuous reminder, being here in the place of the most famous perspective, how perspective is, how to say, an augmentation of a two-dimensional situation. So augmentation, I would say, in terms of data, augmentation in terms of speed, augmentation in terms of information, again, for growth, for inclusion, and taking into account disruption. Now, how will we do this? We will do this with 4 actors that I will start to call now. And the first one is Mrs. Simona Paravani-Mellinghoff, please. She's the Global Chief Investment Officer at BlackRock, previously at HSBC, Julius Baer, and so I would say, one would say a global business actor, if I may. We will do this also with Professor Silvio Micali. Professor Silvio Micali is a former professor of engineering at MIT and founder of Algorand. I just want to recall a recipient of the Turing Award in computer science, the Gödel Prize in theoretical computer science, RSA Prize in cryptography. Now, he's today with another, I would say, if I may, with another hat, which is the one of founder of Algorand. Algorand is for new foundational blockchain developed on a totally new principles to be decentralized, scalable, and secure. We will see how, so we have time to come back to this. We also have, don't want to miss him, Matteo Del Fante. Eccolo. Hi.
Hi,
Matteo Del Fante, currently CEO at Poste Italiane, beforehand CEO at Poste Vita, CEO at Terna, the Italian energy infrastructure. So thank you, Matteo, for being here, and you'll be another business actor and quite an important one. And we should have linked with us, just me check if we go, here we go, fantastic. Mr. Haifeng Xu, good afternoon, Chairman, Bank of China at Luxembourg. Mr. Xu is the General Manager of Bank of China Luxembourg branch, Chairman of the Board of Directors of Bank of China Luxembourg. He's also the Chairman of the China Chamber of Commerce to the EU and board member for the Luxembourg Bankers Association, ABBL. So, Mr. Xu, good afternoon. Thank you for being with us. Now, how we will do this, and I'm ready to enter into, let's say, the discussion. We will try to do this in 2 rounds. 2 rounds of, let's say, with common questions at the center. And I would start with the first round, if I may. And starting by a recent Financial Times quite long article, maybe too long, but say quite long article, that came quasi on time, just on time, on the culture, let's say the cult of crypto. That was that inside the cult of crypto was the title of the article. And say that article, in dwelling on the roots of the crypto culture, maintained that, and I'm quoting, like many new technologies in human history, crypto has attracted genuine investors and utopian ideologues, technocratic dabblers and bored punters, scam artists and sharks. Now, this is, I think, the goal used to say vast program, so it's quite ambitious overall picture. Still, I would say, coming back to substance, we know that, for example, DLT technology, through its disintermediation effect, may offer new opportunities for substantively accelerating expansion of financial services. And this applies both to developed and even more to developing economies. And beyond DLT, the financial sector is applying AI at an accelerated pace throughout its bouquet of offers to gross and retail customers. So I would say we will have two rounds. In this first round, we would leave the sharks aside for a while. We'll come back to that. And let's see the positive side, which is, although I would say we leave the sharks aside as a regulator, in the regulatory process, we need to take into account of sharks and provide substantive and quick answers to the challenges that sharks do pose. As I said, we'll come back to this. In this first round, my question to you is, in your view, which concrete steps can we, and we, I mean business, a regulator, research, take to move from utopia to reality, and possibly in a short time frame? So answers for substance and in a quick time frame. I would start with Simona Paravani, if I may.
Thank you very much. I'm deeply grateful to Consob, Consiglio di Stato, and the G20 for the opportunity not just to be part of today's panel with such distinguished guests, but also to be part of the broader conversation around the opportunities and, let's face it, the challenges that the new technologies bring. On a more personal note, I'm also deeply honored as an Italian woman of rather humble origin that such an invitation has come under the Italian presidency of the G20. There is little doubt that artificial intelligence presents great opportunities, and there is even less doubt in my mind that to capture such opportunities requires a great deal of cooperation. To quote a favorite African saying, if you want to go fast, go alone, but if you want to go far, go with others. The successful deployment of AI to help more and more people achieve financial well-being is a long journey and requires all of us, financial services, regulators, and academia, to travel together on that journey. Before I dive into a more detailed discussion on the concrete steps we can take to accelerate the journey to a future of financial well-being facilitated by AI, I'd like to, let's say, set the scene by defining a little more the notion of AI and its application specifically in the context of investment management. As it is often the case with new technologies, there is a fair bit of confusion and, let's face it, myth on what AI actually is, its potential and its pitfalls. Broadly speaking, one can define AI as a broad class of systems that enable machine to mimic advanced human cognitive capabilities, such as recognizing a face or make a book recommendation, to quote a couple of examples that are already part of everyday's life. When it comes to the potential application and risk of artificial intelligence more broadly, there seems to be a rather polarized set of views between, on one end, those that believe that AI will make human intelligence redundant. So this is some kind of Matrix-style dystopian future. And on the others, those that believe that AI is just, quote unquote, a lot of hot hair. The correct answer is most likely somewhere in between, with the true transformative power of AI lying in the combination of human plus machine. We should also be very vigilant against the myth that AI is unbiased. AI applications are as biased as the data that we use to calibrate them, a point that was brought to light by, for example, the assessment of sentencing algorithm used by judges in a number of districts in the United States. Such algorithms that aim to help judges determine the appropriate sentence by assessing the likelihood of reoffending have been found to be biased against specific socioeconomic groups because of the association that they draw from the existing inmates population. This example rightly puts the spotlight on data and the importance of relying on data sets that are representative and inclusive, a point I'll be returning to shortly as it touches every application of AI. Talking of the AI applications in finance, there are obviously multiple, but let me focus on investment management applications specifically, as these are the ones I'm closest to as Global Chief Investment Officer of a book of multi-asset mandates that spans geographies and asset classes. We are privileged to manage assets on behalf of a variety of clients, including pension funds, insurers, and sovereign wealth funds. Broadly speaking, the goal of artificial intelligence application in investment management is to build more resilient portfolios for our clients. This has many facets, but two in particular are worth emphasizing. First of all, building resilience through more informed investment decision. This is about synthesizing vast amount of information from financial and non-financial sources to develop a set of proprietary indicators to enable our investors to make better, more informed decisions. And this should in turn yield better risk-adjusted return. An example of such an application available on our website is the BlackRock Geopolitical Risk Indicator. It is a measure of market attention to a variety of geopolitical risk. This indicator leverages cutting-edge natural language processing techniques combined with insights from our investors to identify key geopolitical risk and the extent to which they may be already reflected in market prices. AI is also employed to identify common drivers of security by using increasingly sophisticated regression techniques and bigger data set. And furthermore, AI is enabling us to use more robust portfolio construction techniques. An excellent example of this is summarized in the paper Reconstructing Emerging and Developed Markets Using Hierarchical Clustering that was authored by a number of my colleagues at BlackRock and was published in the Financial Data Science Journal recently. The second area of building resilience is building resilience through plumbing. Yes, I said plumbing. I recognize that this may sound a bit odd, but please bear with me. Some of the most impactful, yet probably least celebrated applications of AI relate to the ability to gain operational efficiency and resiliency by, for example, extracting data from a PDF rather than having the fun of manually typing them in, flagging outliers rather than just relying on human eyeballing. Now, I appreciate a lot of these applications are as exciting as watching paint dry, train spotting, you pick your analogy, but they are a must. Otherwise, it is a bit like building a wonderful house without solid foundation. It is important to note that none of the examples I mentioned is suggesting a world where AI applications are autonomously, and I underscore this word, autonomously, making end-to-end decisions that impact a client portfolio. The driving vision here is one where AI can help investors make better, more informed decisions. It's not about a world where human intelligence becomes redundant. So what additional steps can we all take together to accelerate further the positive impact of AI? As data is the energy source of AI-based application, it won't be a surprise that the focus is firmly and squarely on data. First of all, coordination around access and usage of data is absolutely key. It is acknowledged that with the explosive growth of data that touches on every aspect of our life, from book preferences to what's in our fridge all the way to our medical records, the rules that govern access and usage may need to evolve over time, but it is paramount that such an evolution is not without warning and it is not without due consultation with all parties. Abrupt cessation of access or limitation to the usage of a particular data set, trivial as the data set itself may seem, can have significant downstream implications because of the way machine learning models are calibrated. The so-called entanglement problem is especially pressing in machine learning applications where changing anything changes everything, as explained in detail in the seminal paper, Hidden Technical Debt in Machine Learning System, authored by a group of senior researchers at Google. A well-coordinated approach to evolving access and usage of data is therefore key if we want to avoid downstream disruption that could damage consumers and society at large. Second, storage of data and resiliency. Given the criticality of data, we need to ensure that data is stored in a way to maximize resiliency and thus best protect the interest of consumers. In this respect, a more decentralized, flexible system like the cloud may be a more resilient alternative to the traditional ways of storing data. And finally, and very importantly, the data needs to be inclusive and representative of society at large. Advancing the digital inclusion agenda should be a key imperative for regulators, academia, and business. The scale of the digital divide is clear. When we think that despite the rapid expansion of the internet, 40%, 40, of the global population is still without reliable access. On a global scale, there is also a clear gender and age divide in access to the internet. This implies that women and older cohorts of the population are contributing less to the very body of the data that we then use to calibrate the algorithms we build with the aim to serve them better. I mean, the paradox here is pretty clear. Tackling the digital divide is not just about fast, reliable, and user-friendly internet access, but also about ensuring technological innovations are evaluated by a truly diverse group of potential users. If the latter does not happen, we do run the risk of backing the wrong horse in the innovation race. In this respect, there is a very topical and powerful example from history, the electric car. Yes, while the electric car is seen as a very recent innovation courtesy of visionary entrepreneurs like Elon Musk, the reality is that electric and petrol cars were both around in the 19th century. Interestingly enough, around 1900, actually electric cars could accelerate faster and brake better than petrol cars. So why did the electric cars fade into almost oblivion? Of course, there were multiple reasons for this. But as it is comprehensively documented in the book, Mother of Invention, gender was one of them, and an important one. With their, and I'm quoting, odorless, noiseless, and stylish nature, as if said in an advertisement from 1903, electric cars were seen as the car for women. The image didn't limit their appeal to men, who ultimately were the main buyers. The rest is history, as they say. So, thinking back at the African proverb I quoted at the very beginning, it is essential we travel the journey to the financial well-being for more citizens by truly traveling together. Together does not only mean a partnership between regulators, academia, and business, but it also means ensuring society at large is included and represented in what will no doubt be an exciting journey to an even more exciting destination if we truly travel together. Thank you.
Well, thank you very much. If I may just pick one of your issues of the many, one that is very at the heart of the work of the financial regulators worldwide. You touched on bias issues, which has, for example, this is the way we see this, major impact in terms of corporate governance processes, responsibilities throughout the governance process. And I think, thank you for the point, and I think something to keep in mind and let's say, maintain whilst we go on in the discussion. Professor Micali, shall I ask you to go for your next round?
Thank you, Commissioner Ciocca, for this fundamental question. My answer may come as a surprise. I firmly believe that technically we are way past utopia. Reality is here, the future is now. But the media, except for the most professional media, are stuck in an old narrative. So, one thing we can and should do immediately is to correct outdated perceptions. So what are the most frequent misconceptions in most of the media? Well, all blockchains are the same. All blockchains are bad for the environment. Blockchains are a solution seeking for a problem. These statements have one thing in common. They are all false. Then, what is the truth? Truth part one. There exist different types of blockchains. First generation blockchains could not simultaneously be secure, scalable, and decentralized. This was unfortunate because each of these three properties is crucial. Second generation blockchains, however, are secure, scalable, decentralized at the same time. And so they should be in order to be useful to the world. Truth part two. There exist green blockchains. True enough, first generation blockchains, which still operate today, consume as much electricity as a small country. But second generation blockchains consume in total the energy equivalent of 10 homes. 10 well-lit homes, perhaps, but only 10 homes nonetheless. This is important to understand. The idea that blockchain progress necessarily comes at a cost for the environment is just the dystopia of the uninformed. Truth part three. Second generation blockchain offer powerful solutions to real problems. Sure, first generation blockchains could just offer an immutable archive of static data. Thus, they could only provide, at best, digital gold, at worst, only speculation, the false promise of high returns on small investments. By contrast, second-generation blockchains offer way more than an immutable and transparent database. They also secure all kinds of transactions. For instance, they enable two parties to exchange assets directly without having to rely on costly intermediaries. In a single indivisible transaction, in just a few seconds, with total security and at the cost of a fraction of a cent. Such security and such time and cost efficiencies are crucial to small and medium enterprises and wherever economic development is needed, because traditional mediators are too costly and do not have the financial incentives to enroll ordinary people and help them in their ordinary transactions. More holistically, the truth is that second-generation blockchains are an instrument of real progress. For the first time in finance, bilateral exchanges can be truly simultaneously secure and unmediated. Mediators that add value to the transaction will always be welcome. But when the only function of a mediator is to enable the transaction itself, then what is welcome is a secure and efficient technology that replaces that mediator. To be sure, some countries are lucky enough to have already in place payment systems that are electronic and extremely fast. Yet, such payments are still unilateral. Even when they are used to purchase digital goods and services, expensive and slow architecture must be relied upon to guarantee that you will get what you are paying for. Payment versus delivery continues to be a major problem. and even when payments are super fast. Only second-generation blockchains have finally solved these vexing and century-old problems. But not only that. Second-generation blockchains provide a sustainable, incorruptible platform on which air and water quality can be monitored by a multitude of independent actors, and thus with no cheating. They provide a platform that is so efficient and so decentralized to really achieve financial inclusion. They provide a technology enabling the public administration to become the transparent house, quella casa di vetro, which is the very goal of our esteemed host today, il Consiglio di Stato. All of this is possible today, not in some mythical future. Cost, performance, and sustainability are no longer barriers to mass adoption. We must correct outdated narratives, and all of us, businesses, regulators, and researchers, must seek and be open to new information that is aligned with current reality.
Thank you. Thank you, Professor Micali. I would say truth path 4. We need to go a bit more into the details of the second-generation blockchains, because you touched on some delicate points like payment versus delivery, that for the financial infrastructure is at the heart of the functioning of a centralized system, and the way this, well, not will work, works. Currently, I think it is crucial that we'll come back to that, I'm quite sure. Now, Mr. Xu, can you hear us? Fantastic. So if
Yes.
so, can I give you the word so that you can give us your perspective on this, please? So we are at the center
yes.
of utopia now, no? And we move from utopia to reality. Please, Mr. Xu.
Thank you. Thank you very much for having me to this important forum. For me, I think I want to broadly elaborate my idea about how to promote the digital innovation, maybe not go into a detail technology. I think now we are in the fourth industrial revolution. While we build the digital economy, we can always see the latest technology and the innovation infrastructure, the changing the industrial production and the people's lifestyle, like 5G, big data, artificial intelligence, Internet of Things, just a few examples. And during the pandemic, the COVID-19 pandemic, for instance, digital technology has provided great support for prevention and control, such as the Chinese health code or the European vaccine passport. Simultaneously, the new industrial and the new business model based on digital technology has been widely used, like online meetings, cloud office, online shopping, guarantee the continuation of our work and private activities. At the same time, the digital economy has contributed significantly to the economic recovery during and after the pandemic. Let's take China as an example. In 2020, China's digital economy amounted to roughly $5.4 trillion. It's almost the same as the third largest economy, and account for 38.6% of China's GDP, grew by 9.6% year on year. So it shows how the digital economy provided the significant support toward China's economic recovery and growth. However, we need to create and maintain a suitable environment to further promote digital innovation and to support it in the appropriate financing instruments. First of all, we need to build a comprehensive information infrastructure. In the financial sector, for example, digital finance has changed the traditional service for the deposit, lending, savings, investment, greatly changing people's lifestyle as well. However, all these services depend on the development and the continual improvement of information infrastructure. E-commerce also requires similar attentions. For example, for like China's Alipay is online payment system company. Alipay went online in China at the end of 2004. By 2020, it has 1.3 billion annual active users and processed 17 trillion US dollar worth of transactions in the year 2020. But its rapid development and achievements were only possible thanks to the simultaneous development of China's large-scale information infrastructure. So without the very solid infrastructure, we will not have these strong digital innovations. And secondly, we need to create a regulatory environment which encourages innovation. For instance, like in 2015, the UK Financial Conduct Authority took the lead in putting forward the innovation concept of a supervisory sandbox, which encourages innovation while ensuring that risks are kept in a reasonable range. Recently, China and Hong Kong agreed to set up a one-stop regulatory sandbox platform to allow new ventures in the Guangdong, Hong Kong, Macau, Greater Bay Area to develop cross-border instruments for financial technology. And this will greatly support the works of financial innovation companies in the Greater Bay Area. And also in the recent years, several well-known fintech companies such as Alibaba, JD.com, or TikTok have emerged in China, thanks to the encouraging and innovative support of the Chinese regulators, and they enjoyed rapid development. And thirdly, we need to improve the technological level of financial supervision. Unfortunately, like a cryptocurrency market, like Bitcoin, is brimming with scammers or some frauds. But this is an important reminder that financial supervision needs to strengthening, and that the technological level of supervision require constant improvement. In the digital economy, supervision needs to keep up with emerging technologies such as big data, artificial intelligence. To do so, we shall enhance the technology capabilities of financial supervision and to provide guidance to ensure that a healthy development of the digital economy. And fourthly, we think that we should speed up digitalization in the financial sector. The financial sector is very receptive toward the new technologies and is quickly implement them in large scale, thus revealing urgent need for digitization. For example, cloud computing can support operations and maintenance of IT assets in the financial sector. And the big data can play a role in marketing, data analysis, and risk control. And the digital transformation has greatly improved the efficiency and the quality of financial operations. And it has further improved the ability of financial institutions to boost the real economy, and in return can foster innovation in other fields. So lastly, we should strengthen the international exchanges and rulemaking. In the era of the digital economy, the capabilities of existing legal system and supervision mechanism are lagging behind. Data transparency is low, and information infrastructure is insufficient in some regions. Achieving efficient use of data, we should strengthen international exchanges and cooperation, jointly promote international consensus on the governance of the digital economy, and that we support the digital economy and the innovation worldwide. Thank you.
Thank you, Mr. Xu, and thank you for your thoughts. You touched upon how crucial the information infrastructure is in order to, let's say, to have at least a starting point where then you move on with artificial intelligence for the financial sector. You also touched on a regulatory tool like let's say, the supervisory sandbox, which was touched this morning by President Savona, Professor Savona, and that for regulators is always how to say, catch-22 situation in which you want to innovate, at the same time you need to let's say, to take into account, let's say, how to protect, for example, investors. So it's even a challenge, or maybe it's a challenge for regulators themselves. Well, having said that, so thank you, Mr. Xu. I would come to Matteo Del Fante. Mr. Del Fante, Matteo, you are the CEO of, if I may say, the most capillary financial intermediary in Italy. So you touch, let's say, on a daily basis, on a daily routine, on the challenges of provision of inclusive financial services, if I may put it this way. At the same time, not only financial services, because it's logistical services and many other things. What's your perspective on this?
Thank you. I will not go deep into AI because Professor Michali, I feel a bit shy on the topic, or not discuss in front of BlackRock about, I think BlackRock passed the 10 trillion mark this month, correct? So 10 trillion asset under management is clearly remarkable. In our small world, we certainly consider, as Mr. Michali said, that we are out of the utopia. It's happening, it has happened, and it has to happen. Why it has had to happen? Because we believe, and this is a discussion I had with Larry Fink a couple of times, that there are some areas of the financial space which are still not efficient. The one I discussed a couple of times specifically is the currency transfer. If you think that, today there are a lot of poor people or quasi-poor people living around the world, sending money back to their families, and they're charged as much as 10% for the money they send, and these are people that are, earning base salaries. Maybe, there is something, that in the financial margins, as we can call it, can be improved. It's the second crisis, if you think about it, the one of the pandemic, where we thought that maybe the financial system would have suffered. The previous one, 10 years ago, proved to be actually, an element of strength for most of the big players. This pandemic crisis has clearly pushed the habits of citizens, of retail, for sure. We estimate, looking at our 35 million clients, 3 years ahead. So we are observing today what we would have observed 3 years down the road because of the pandemic. Some people say 5 years, but it doesn't matter. It has pushed the timeline forward. And that, I think, is clearly going into the digital usage. And, in Poste, what we feel is that we are the provider of what is still called and is in a contract with the Italian state. And, I thank for being here, the Commissioner, especially President Savona. The link with the state for Poste Italiane is the universal service. So the right of every citizen to receive and to send one paper, letter, or box. And if you think that this right is, what makes this company, living for the last 160 years, we feel that maybe in the future the easiness of the use of technology should be the new universal service. And so we should all work for technology to be available at a cheap and easy way for all citizens. And from our standpoint, to achieve this goal, so to make it happen, which is, the question, from opportunity to growth, it has been discussed this morning, been briefed by my team, regulation gap, let's call it. And certainly sandbox in the regulatory space, scale box for fintech that want to test their systems. So regulation is at the center of this transformation. How do we help regulation to do the right thing for the system? We have adopted, and is limited to our small garden, quote unquote. We have adopted a model where we identify the growth of the industry. Let's talk, let's take an example in fintech, the paytech. So the subset of fintech that looks at payment, okay, which is still a sector that is a bit old style. It's a sector where every time you do a payment, you charge a fee, okay? All the new payment companies around the world don't charge a penny, take information from the transaction and extract value from that data, okay? So always think about that movie, I'm sorry for the non-Italian, but it's the famous One Fiorino of, every time you pass is one Fiorino. That's the past, that's 1492. It's not the future. So how do we try to get that, one Fiorino out of our business model? We select those paytech specifically that are in our roadmap. So which one are going to make us going faster where the future will go? And this company can be in Italy, hopefully, or they can be around Europe. And specifically, we found a couple that we selected, and at that point we become clients because we need their services because they're good, but given we're, in terms of number of transactions, big, in becoming clients, we give scale. So we are a kind of a applied scale box, President Savona. So I know that the moment that my company becomes client of one of these companies, they're not a startup, they're not a pay tech, any longer. And then, I choose them well, and I become shareholder, so that we benefit together of me being part of that, and that is a way for sure of solving also the regulatory gap, because I'm regulated. Everything I do, specifically the company we selected are in line with the new European directives for payments, and they help us implementing those directives. And given I am regulated, the regulator knows that we're going in the right direction. The second element to make this happen is clearly skills and talent. We need certainly in Europe to have more brains. There is still a lack of programming, of coding profiles. and more ties in between corporates and research centers, universities, is the way to go, and I think it has been recognized also in the academic space even more than in the past. Support investments, because this is a third factor where fintech can benefit from the support of financial companies that can provide funds for their developments. I think there is the need for a European, at least, share of information and connections on these topics, which is probably not enough developed, and maybe at the government level, which is my last point, we should consider maybe some R&D in the space, tax credit specifically, because there is still in this transition. Think about cloud, an example that I use often. When you take your company from domestic in-house servers, where you make CapEx, and you say, I want to be modern, I want to be fast, I move into cloud. What you spend into cloud is considered OpEx, so it's a cost in that specific annual income statement. What you were spending in-house was a CapEx, an investment. So, sometimes the accounting doesn't help moving towards the future. So these are my 5 suggestions. Thank you.
Mr. Del Fante, thank you. Your last point is a delicate one. I don't know what would think tax authorities to in terms of, well, okay, let's leave aside, but the point is taken, you are right. There is a new combination between CapEx and OpEx. The time we move to a central, how to say, infrastructure like cloud. Good point. The other point I wanted to keep is that if I got it right, and you made a point about new models at no cost that take info and extract value out of that info, which is the typical, I would say, innovation business model. At the same time, into this, you Poste, you make, I have to say, innovation at scale. So your point is taking that and making this then something which is mainstream, not only an experiment. You bring it into an industrial process. Now, this brings me to the second round, if I may, because you remember we left sharks aside in the first round. Now, I would say, let's bring into the picture scam artists and sharks. And as an economist, let's remember that here too there is no free lunch. There's never a free lunch, but I mean, in these issues, I would say the less so. And here, let's say there is no free lunch when we move into at scale, at mainstream. I mean, not any longer, again, a scouting experiment, a sandbox, but we bring innovation into, let's say, and for example, blockchain, but the same applies to AI. So we have, obviously, innovation opportunities at scale. At scale means at the level of a full-fledged market in which I may have let's say, I may have retail, I may have unprotected retail, I may have everyone. And this comes with, let's say, I would say, opportunities, at the same time, challenges and risks. So my question to you would be, in your experience, which are the main current and perspective obstacles to a speedy deployment of inclusive financial innovation on a global scale? Global means could be national, regional, global in strict sense. How can regulation international and business cooperation, so regulation, international cooperation, business cooperation, support in helping these hurdles that you may see. I would start this first round with Mr. Xu, if he's in agreement, and if you wanna go first, and then we'll go ahead with colleagues.
Thank you very much. So for this topic, especially referred to the inclusive finance. First, I think we face many challenges. For example, the development of the infrastructure in some developing countries still lag behind. And we see big tech firms have gradually formed monopoly situations in financial and customer service in recent years. Some of these companies that become too big to fail. And also, we see that currently the data flow, storage, and processing of data are in the trend of geographical restrictions because of a concern linked to the geopolitics and protectionism, among others. This also results in barriers for the globalization of financial innovation. And also, of course, the inadequate financial education is also a major obstacle for financial innovation and for the inclusive finance. This is some of the obstacles. Of course, in the center, there will be, the regulatory and the supervision is the key, to the development of the inclusive finance. And for this, I want to say that for the supervisory authorities, enterprises and individuals are facing different issues, like in terms of regulation due to the fragmented market, lack of transparency on information exchanges, delay in new technology implementation, together with many other reasons. The supervision really bear the responsibility on the existence, on the pricing and efficiency of the inclusive finance. And from the enterprise's perspective, the current business model are rigid and does not possess enough sensitivity to apply innovative technology internally. For example, for the banking sectors, with a traditional mindset, many consider inclusive finance as a business with a high risk, high operating costs, but low return. Without technology innovation, it's unlikely to overcome these above-mentioned hurdles, such as optimizing their customer sentiment and conduct risk analysis, which provide their customer with proper financial services. Meanwhile, on an individual level, many tend to follow blindly on so-called new technology and lack of financial education, inconsistent with information, and incomplete credit records and basic knowledge on new technologies. This is some of the obstacles we met with. And I think for this, for inclusive finance, one of our very important tool is really related to decentralized public blockchain will provide a framework to enable financial inclusion. And now, one crucial feature of blockchain technology is capability to provide banking services to people who not have a bank account, especially in those very poor and far rural area. Many people just cannot access to the banking services. According to the World Bank, nearly half of the world lives on less than $5.5 US per day. Unbanked population do not have, in many situations, identity documents as they don't have means to pay for them. Blockchain-based identities would not require typical legacy documents and would involve billions of people to become easily identified on a public blockchain. So blockchain technology can clearly help people around the world spend and exchange money in a cheaper and faster way. It could also use to provide transparency to government public spending that should be allocated for financial inclusion projects. Nowadays, mobile payment, even in low-income countries, is over 50%. Mobile app interacting directly with blockchain technology could easily serve a large number of users and greatly promote inclusive finance. And thirdly, it is also necessary to accelerate the digital transformation of financial institutions. In China, for instance, several major commercial banks, including the Bank of China, have built online microfinance platform by mapping the credit data, by elaborating customer profiles through artificial intelligence and big data. This platform can significantly reduce service costs and ultimately benefit banks' customers. And it also, like the bank, easier to reach out to a big number of users. And a similar platform allows banks to achieve intelligent and automated mechanisms for approval and for risk management. We have noticed that in a similar way, many local European banks have adopted regulatory technology to reduce the compliance cost and enhance the regulatory processes. And the most important is the growing demand for the data governance and for the personal information protection. That is one of the crucial areas that we need to look at. That improving data governance and privacy protection is essential for the financial innovation and for the development of digital finance applications. Public policy making on modern data rules and protection should be encouraged worldwide so that the financial innovation can meet no barrier. Like EU's GDPR is a good example of policy making in this regard. And also China's personal information protection law, which is aimed for comparable level of protection, will enter into effect on the 1st of November of this year. This is my elaboration on this topic.
Thank you, Mr. Xu. Thank you, Mr. Xu. And well, we started this second round with it's a question at the crossroads of some delicate issues, because you have together coming in when you want to outreach and you want to outreach. So you use technology, you use DLT, and at the same time you want to select, you want to discriminate in the technical sense, you want to understand what's in this outreach. So then you cross privacy issues, what we call privacy issues may be called something different. You may have other, let's say, issues that come at the forefront, and I'll say this equation is not an equation that it's easily solved everywhere, and you have different ways to solve it. For example, in the Chinese case, it's quite interesting to keep in mind the capacities of the cyberspace administration, even on financial matters. So I think, thank you, Mr. Xu, for your contribution. If I may turn to Matteo, to Mr. Del Fante, how would you see this By the way, Poste Italiane has an history of being at the forefront of combating scams and so on. So how do you see this issue on your side, please?
Yeah, before I go into Poste directly, we see obviously regulation to be run by specific rules which are country most of the time specific, or in our case specifically country-specific, driven by European directive. And we see that the larger the single regulation market you start from, the greater opportunity for market participants. And therefore you have, maybe China and the US have had in the last few years the opportunity to attract larger investments in their fintech companies with also potential upside for the valuation and the development of those companies. And this, in these areas of the world, you could almost say that there is a kind of, a soft power in these economies that is moving to some of the fintech. And this is not, playing well on the European side from what we can see of the scheme. The UK, delinking and exiting Europe has moved very fast, in our opinion, developing a consistent set of rules and regulations as an early adopters, and that has helped the SMEs financing and specifically, which is clearly very important for the economies. And Europe, we believe, has been introducing specific directives, obviously including aiming at having a more inclusive and transparent and efficient financial services industry, and these obviously cover from payments to financial information to lending to investment services to crowdfunding and soon into crypto. There is a clear window, in our opinion, for local regulators and business to cooperate at this point in time with policy makers to accelerate the rollout of the benefit that derive from the new EU directives. This will instigate a virtuous cycle of greater investment, better and more competitive players, a more and more transparent industry that, at the end, will compete with traditional players in gaining the trust of retailers and SMEs. And those EU countries that will be better at tackling those practical obstacles to innovate models will grow, in our opinion, faster than the other. There is a recent study from the European Banking Association describing the so-called platformization of the economy that needs an even stronger coordinated approach on these topics. And only by focusing on creating a level playing field we can reach healthy competition in companies that are going also beyond specific industries. So it's not only fintech the topic when you are in platform company space. Two topics in terms of businesses which we think are important. Fintechs support and are a great opportunity for SMEs, and we call this financial inclusion as a label. Alternative lenders and challengers banks are connected to growth through small firms. And if we look at Italy, lending is a competitive space and higher speed of access to credit with, fintech players has happened and is happening in Italy, also thanks to the public guarantee schemes that we know is working extremely well. So Italy is an example in that respect, and direct lending and debit funds are also playing an important role in supporting the banking sector in giving credit to the SME space. Italy, on the other hand, I believe is a bit late in open banking. So, comparing the user experience of our retail clients with the best in class in Europe, we have to do more. And Poste is trying in this space to, as an incumbent, to be the phygital player of the space, where as an incumbent player with, as you were, Commissioner, introducing the most capillary company in the country, to be also, as much as we can, the most technical company in the country, because we believe that the two things need to go together. And I think, a very important example of this has been what Italy, also in the context of the G20, can mention as a really proud achievement of our economy in terms of digitalization, is what we managed to do with digital IDs, with speed. So you know that we're the very best country in Europe for number of citizens that have a digital ID that is user-friendly and is now, moving to, a very high level of utilization. And you have to know that Poste has helped, together with other 8 providers, who are the main issuer of the identity for clients, but you have to know that more than 80% of those IDs have been granted physically in the office, and we keep maintaining those IDs in the offices. So hard to think about a transition into the the fintech, the pure fintech and the pure digital space with all the AI, with all the data value, with all the technology, you can put in the engine of our companies if you don't have a touch point, a physical touch point with your clients. And the second example of this has been, and I want to mention it because we are extremely proud of it, is with our tech-intensive role that we invested significantly a few years ago. We offer last year a digital platform which was developed 100% by Poste Italiane employees, so no consultants, no external developers. So this was the agreement with the state. We offer this platform for vaccination, and this platform has helped 8 regions in Italy to vaccinate almost 40% of Italians. This is 10 seconds of advertisement that we feel very proud, and I wanted to share with the audience. So I think I go back to my first 5 points: people, talents. We do a lot of that inside the company. In terms of not only hiring but also training and using as much as we can new technology tools that our employees are adopting very fast. I mean, that vaccination platform was developed by 60 colleagues in full lockdown period on one digital platform, and it was 7 days, 24 hours, and everybody was giving inputs to this joint effort. And I would like to close my contribution going back to the words of Chairman Paolo Savona when he mentioned that the main character of digital innovation is to appreciate that notwithstanding competition and challenges, we are into a radical transformation of our ways, not only to do finance, but to every aspect in our life. It is a social transformation into a mixed physical and virtual reality, and we need to remain anchored to the core human experience by using finance to build, construct everybody's future. And thank you for the opportunity.
Thanks to you. Thanks to you. I quickly move to our two colleagues in this workshop, but I want first to keep in mind, you made a point about, if I got it right, that sometimes from a regional EU perspective, we have good ideas in terms of regulation. We take a bit too long time to enact them. And I think this is, for example, something that we are experiencing currently with the digital financial package, which has been quite a comprehensive and let's say a Cartesian way to approach crypto assets. Still, the time it takes to close the negotiation with member states makes that others, let's say, may move faster in the same direction. So this is something we touch, we feel, at least as authorities, quite sensibly on this. So moving on, Mrs. Paravani, Simona, please.
When it comes to innovation obstacles on the road to financial well-being for more and more people, including, to quote the question, how to avoid scam artists and sharks, the key is to empower consumers. How can we collectively help do that? Empowerment of consumers requires access and choice in all its facets. So this is access and choice to products that enable clients to achieve their financial goals, whether it is buying a house, retiring, or kids' education. As we think about access and choice, due consideration should also be given to opening up the full spectrum of investment opportunities, including private markets, to more and more investors through initiatives like the European Long-Term Investment Fund. Such a structure is expected to help opening up private markets to more and more investors, especially for their retirement savings. Such an initiative would seem to be a step towards a win-win outcome for consumers who can access additional sources of return and diversification, but also for companies that can access additional patient capital that in turn can foster innovation. Access and choice also means speaking the language of our clients. This is not just about making the language we use to describe product and services more intuitive and jargon-free, which I'm sure everybody would appreciate, but it goes to the very core of making finance more inclusive. Talking about money is still unfortunately largely seen as the prerogative of the privileged few. But this must change, and it must change fast, to a narrative where talking about money is for everyone, because everyone should be enabled and empowered to experience financial well-being. The pressing need to improve financial well-being was clearly highlighted in a recent OECD survey of adult financial literacy that showed that, on average, the sample respondents do not consider their financial situation to contribute positively to their well-being, but rather to add stress and worry. What does it take to foster and embed a narrative where talking about money is for everyone? There is obviously no magic wand, and one should recognize it is a marathon, not a sprint, but there are a couple of steps that are especially critical to realize such vision. First of all, the investment management industry, and more broadly, the financial industry, needs to become more representative of the communities we are privileged to serve. Attracting and retaining diverse talent should therefore be seen as a priority for our industry. And when I talk about diversity, this is about gender, race, but also socioeconomic background and much more. Industry-wide initiatives that help attract more diverse talent through early engagement with diverse, underrepresented community should and can play a meaningful role in advancing the diversity, equity, and inclusion for the financial industry. An interesting example of this is the Big City Bright Future initiative, which was originally founded by BlackRock and now involves over 20 global firms in London, Edinburgh, and Paris. The program, which consists of a 3-week paid internship for students in the last year of school before university, aims to increase access to competitive areas of employment from students from underrepresented backgrounds. Such programs do make a difference. 88% of participating students in Big City Bright Future have gone on to university, compared to 26% of students from a free school meal background, which is effectively a proxy for low-income cohorts, and a 41% national average. So it's a clear win-win. Furthermore, we need to acknowledge that financial literacy is an essential skill in today's world and make it a priority. The OECD survey of adult financial literacy concluded that financial literacy is low across the broad sample of 26 countries in the survey, with average financial literacy scores at roughly 60% of what would represent a basic, and I stress the word basic, set of knowledge, concepts, and financially prudent behaviors and attitudes. Financial literacy assessments also reveal meaningful differences by gender, race, and ethnicity. In the paper, How to Strengthen Household Financial Resilience, Professor Anna Maria Lusardi and colleagues from Stanford and George Washington University found that the percentage of financially literate individuals among Black and Hispanic communities in the US was 15% versus 36% for the rest of the population. Similarly, only 22% of women are found to be financially literate versus 39% of men. Such differentials matter and have further downstream implications. For example, the gender gap in financial literacy is seen to be a contributing factor to the gender pension gap globally, as women tend to save and invest less for their retirement. Improving financial literacy across society is an ideal goal for policymakers, academia, and the financial industry to partner together on. Each of us can bring something different and additive to solve the problem and make a real difference. The financial industry has domain-specific knowledge and resources, but broadly speaking, we lack know-how on how to teach or access to the relevant platforms, in other words, the schools. Policymakers are key in ensuring school curricula reflect the importance of financial education and in establishing the rules of engagement to enable effective partnership between educator and financial services firm for the development and delivery of relevant material and content. The potential for broader and deeper cooperation in this space is further underscored by the fact that advancing financial literacy is not just a top-down corporate imperative, but also reflective of a genuine bottom-up passion and interest from people working in the industry at all levels. We have experienced this firsthand at BlackRock, where our most recently founded employee network is the Financial Inclusion Team. The group, which spans across geographies, departments, and levels of seniority, is committed to helping more and more people on the margins of society experience financial well-being through a focus on economic mobility and financial inclusion, of which financial literacy programs are a key component. To conclude, as the question postulates, innovation opportunities in finance do come with challenges and risks. We believe that empowering consumers through product access and choice, through inclusive representation and financial education, is key to reap the benefits of innovation while minimizing its potential pitfalls. Effective empowerment of consumers requires a close cooperation between policymakers, regulators, academia, and the financial services industry, because if we want to go far, we need to travel together. Thanks.
Thank you, Simona. I keep your point about not being there any magical wand. Still, I take your point about, if I can translate this, diversity at scale. This is one point. I fully in agreement. On the other hand, you have underlined how crucial financial literacy is. And there I would say for incumbent small or big. Yes, the sooner the better before Google does it, as currently is happening with sustainability, and where I think my impression is that it goes, this is the new disruption, which you take a topic which is global, you enter through this, and then once you are in, you move into financial and so on. But that's another story, we will come back to that. Now, Professor Micali, the last word is yours. So on this, I would say truth part 5, you go.
Thank you, Commissioner Ciocca, for this question too. So it is indeed urgent for regulators to intervene in blockchain matters and to do so correctly. To begin with, we must acknowledge that this is not an easy task. Correctly regulating the blockchain requires grappling with two major issues. First issue, some blockchains are simply bad. They promise financial inclusion, but they either fail to deliver on their promise or worse, harm those who trust them. This is a specific problem because bad blockchains cannot be punished. Whereas the crypto wallets of individual criminals can be traced through forensic work, as platforms, bad blockchains do not have a physical address, do not have a phone number. They are everywhere and nowhere. There are no offices to seal shut. The platform themselves cannot be shut down. If bad blockchains were to dominate the market of digital ledgers technology, it would be a collective nightmare. Second issue. Blockchain technology is already extremely popular and is here to stay. I agree with Mr. Dalfante here. The demand for this technology in so many domains cannot be suppressed. In the world, there is a natural demand for transactions that do not need costly intermediation, for inclusive finance, for speedy, reliable, and transparent administration. With this kind of demand, the blockchain cannot be ruled out of existence. Nature abhors a vacuum. And in the absence of correct regulation, the risk is that bad blockchain will rush in to fill this vacuum and provide ineffective or harmful solutions to the ever greater demand for this powerful technology. Then, how to act? Because punishing bad blockchain is impossible, and because the appeal of blockchain technology is irresistible, let me suggest that what the regulators should and can do is to allow good blockchain projects to fulfill the world's demand, and to do so as quickly as possible. With regulatory uncertainty, good blockchains projects will, by and large, refrain from entering the arena. And with outdated regulation, good blockchains will compete at a disadvantage with bad blockchains that simply ignore all rules. Thus, the danger is that this crucial and needed space will be, yes, filled by sharks and bad blockchains, which cannot be dislodged. So, can we distinguish which blockchains are good and which are bad? Which foster financial inclusions and which do not? I think we can. Let me suggest 7 simple tests that go a long way in this direction. First test, scalability. Financial inclusion, by definition, needs scalability. So a simple but very effective question is, how many transactions per second are possible in this blockchain? If the answer is, say, 16 transactions per second, then there cannot be any financial inclusion. There are billions of us, and with this transaction rate, you are lucky if you can transact once a year. Such a blockchain can only support speculation and does not pass this test. Second test, the cost of basic smart contracts. The quintessential basic smart contract is a bilateral exchange. I have an asset that you want, and you have another asset, for example, money, that I want, and we wish to swap them. Thus, what is the cost of a bilateral exchange of assets in this blockchain? If the answer is 50 cents or more, then this blockchain cannot deliver financial inclusion, because exchanging assets is the most fundamental form of trade, indeed, the art of commerce himself. And because 50 cents are an exorbitant amount when your salary is $50 a month, or when the assets to be exchanged are worth $10. Third test, environmental sustainability. Blockchains, like any other product, require energy to be produced and energy to operate. So, how much power does this blockchain consume? If the answer is a lot of energy, then there is no hope for financial inclusion. And worse, because let's be clear about this, the less privileged ones are the ones to first suffer from the degradation of the environment. A blockchain that is bad for the environment is a bad blockchain, period. Fourth test, consensus. Consensus is the fundamental process by which new blocks or transactions are chosen and added to the chain. So, let's ask, can anyone participate in the consensus protocol of this blockchain? If the answer is sure, as long as you buy a couple of supercomputers, then there cannot be any hope for financial inclusion either, because most of us cannot afford buying supercomputers. If the answer is, sorry, we already have a club of, say, 10, 20, or even 100 agents who are in charge of choosing future blocks on behalf of all of us, then again, no financial inclusion. In fact, such an elitist club has the full power to exclude whomever they want from transacting. Fifth test, continuity of service. Let me put it simply. How often is this blockchain down? If the answer is for a few hours every month, then the chain is inappropriate for financial inclusion. Truly decentralized services, by the way, do not stop working so often. Speculation can easily skip a day, but essential financial services must operate without interruption. Sixth test, upgradability. Can this blockchain be upgraded? Has it ever been upgraded? If the answer is no, never, we are proud that the chain will continue to operate in the same way it has always operated, then walk away. When new and safe technology becomes available, a blockchain must be able to incorporate it seamlessly, without interruption of service, and in an automatic, decentralized manner. Only so can a blockchain continue to satisfy the needs of its community today and tomorrow. Seventh and last test, decentralized interoperability. We should never trust any blockchain, or any infrastructure for that matter, which would not allow us, when necessary, to transfer our assets and our information elsewhere. So, can this blockchain easily transfer assets and information to another blockchain? Can it do so in a decentralized fashion? Unfortunately, most approaches to blockchain interoperability today are centralized, naive, and dangerous. They envisage a few trustees who would tell with absolute authority and hopefully with absolute honesty What is transfer from one blockchain to another? Introducing such centralization is very dangerous because corrupting or hacking a few trustees is very easy. Moreover, imposing a proportionate fine upon a trustee who, maliciously or not, has made a mistake would be an empty threat. The value transacted across blockchains would be enormous, and no trustee would have the ability to pay fines commensurate to the damage done. Decentralization is the real source of security. Interoperability between two blockchains should be achieved directly by the two blockchains involved without the intervention of anyone else. It is only a question of technology, and such a technology is already mature. Let's not settle for anything else. In conclusion, what specific steps should regulators in particular, and more general governments, businesses, technologists, and citizens at large take? In my opinion, two steps: education and experimentation. Education, because we should understand and clarify to ourselves and the general public which technical properties blockchain should have in order to be truly useful to civil society. This step goes a long way towards preventing that individual, businesses, institutions, and governments honestly intending to participate in decentralized finance, transparent administration, etc., find themselves stuck in an inferior blockchain whose technology can only deliver a centralization, if not risky speculation. Experimentation, hopefully through sandboxes, because sandboxes are essential to allow the regulator to understand firsthand not only the potential, but also the limits of blockchain technology. Sandboxes are essential for enabling the regulator to keep pace with a technology that keeps evolving at super speed. The blockchain cannot be regulated with just the rules of the last 2 decades, let alone those of the last century. Only through education and experimentation can we achieve correct regulation, permitting responsible blockchain technologies to help us all to move forward in a safe way, and fostering that financial inclusion and that international collaboration that are at the very heart of the G20's mission.
Thank you. Now, the fifth truth of Professor Micali poses not minor issues to regulators for sure. Just want to note before really closing is that you said some blockchains are bad and they can't be punished. I would add, but for the FBI. So then we know there are ways to be punished, although these are not mainstream. These are not at scale. But apart the maybe not so joke, your 7 points are at the heart of the so-called tech neutrality of regulators when they approach blockchains. So you have a responsibility because you laid down the 7 points that will be quickly introduced into, I hope, as soon as possible into legislation, because they bring, now maybe not straight ahead this way, but these are specific points by which one, let's say, defines tech neutrality. Tech neutrality doesn't mean anything is possible. The point is that you need to define what you want to achieve out of, for example, of a blockchain being a payment infrastructure. So many of these points obviously have been discussed, both in Consob as well as with the Bank of Italy, and are being discussed with the Italian Treasury so that, let's say, suitable legislation can be introduced as soon as possible on this. Now, last point, I think many of you have said education, experimentation, or education, financial literacy, and so on. I think, and these are my last words, what we need in any case to add is also, I would say, regulation and enforcement. We haven't spoken about enforcement because it's always a delicate point, although enforcement is something that, let's say, builds the trust of the market, the more when the market comes at scale. But I'll stop here because I want to thank all the participants, Mrs. Paravani, Professor Micali, Mr. Delfante, Mr. Shu, to you. And we give, let's say, we pass over to the next panel. And thank you again for your availability. Thank you.
Good afternoon. Here we are for the third session. So, in the third session, we will look at the interplay between regulation, digital innovation, and inclusive and sustainable finance from the point of view of the latter. And we want to explore the question, how can regulation drive the potential of digital innovation in finance to deliver for environmental sustainability and social inclusion? Sustainable and inclusive finance has been one of the major trends with an exponential growth in assets under management since 2018. The urgency of climate change, the need for a response, a firm response to COVID-19 pandemics have been major forces of such growth. But the challenges, such challenges, require the creation of a new market infrastructure. And we should not forget that the increasing social exclusion and inequalities are a real threat also for the balance between the environmental sustainability and social progress. This is an uphill battle, and regulators worldwide are looking into this intersection between technological innovation and market forces. Now, this is the opportunity to explore those challenges and solutions already in place with an eminent group of speakers coming from all sectors, so with a rich, broad view on the issue. Here with us, we have Magda Bianco from Bank of Italy. Magda is the head of consumer protection and financial education. At the same time, she is also the co-chair of the Global Partnership for Financial Inclusion of the G20. She will tell us more about that later. On her left, we have Matthew King, Deputy Director and Chief Data Officer at the Joint Research Center of the European Commission. If I may, Matthew, I call the Joint Research Center really the brain of the European Commission, feeding the policy makers. It's great to have you here. Online, we have two other speakers who will connect remotely. We have Karin Isaksson, Managing Director. Hi, Karin. Managing Director of the Nordic Development Fund. Karin has an extensive experience working with financial institutions in emerging countries. Previously, she was with the African Development Bank and Swede Fund. And finally, we have, again online, Mike Froman, Vice Chairman and President of Strategic Growth at MasterCard. Hi, Mike. Yes, we can see you. And he's also the head of the Center for... oops. My tablet technology. It's inclusive growth, but I want Mike also work with the Clinton and Obama administration, and also had the opportunity to work with private banks. So Mike comes with a full array of experience dealing with financial institutions and in all sectors. So I suggest, since we have such a rich breadth of knowledge and expertise, I would move straight to the first question, and let's define the boundaries of our topic. What's this inclusive and sustainable finance? Let's be clear, until a few years ago, most of us, certainly most of the people, did not have a clue. There have been two events have marked the rise of these new forms of finance and the collective awareness. Number one, in 2018, we had the famous letter by the CEO of BlackRock. We heard from BlackRock before. When BlackRock speaks, the market moves. It was really the first time that a market player like BlackRock put a spot on the importance of sustainability. As a follow-up, we have seen a move in the financial markets in the order of trillions as ESG, again, acronym that nobody knew before, and now you will find it everywhere. ESG stands for sustainability investments, in particular environmental, social, and governance. At the same time, last year, we had the European Commission that launched the Green Deal and the Initiative on Sustainable Finance. Those two events on the private sector side and the public sector side has really marked a new tide, what I'd like to call a Cambrian explosion, massive expansion of those new kind of finance in all forms and products. At the same time, we have seen an exceptional growth of market standards and assessment tools. Media claim that there are 600 different solutions for ESG. So such a dynamism comes also with a great uncertainty and clarity and risk of inappropriate allocation of capital, frauds, market bubbles. The so-called greenwashing is not less popular than ESG. So regulators are stepping in. And clearly there is a risk for a potential collision between the institutional prudence and market euphoria. So, shall we put a bit of order in this bubbling new types of finance? I would start with Matthew, because of the first move made by the European Commission, and in particular, I suspect many of you don't know, the JRC, the institution that Matthew represents, in which he works, is the one that has been working on the scientific and technical evidence informing the policymakers, working on the indicators, the data sourcing, the data collection and management. Matthew, would you like to kick off this
okay, Filippo.
Conversation?
Thanks very much for inviting me here. It's a great privilege to be here in such a wonderful location. So let's be clear what we're talking about. I mean, at least from the European Union's political perspective, we're talking about making a success of the twin transitions, the green transition and the digital transition. And if we look at the green, because I think that's where this sort of ESG sort of innovation world is converging, we've got two issues really. One is converting all of those millions of SMEs and companies who are currently churning out carbon dioxide like there's no tomorrow, converting them into more carbon neutral, sustainable businesses with the help of finance. And also, and this is really important for us, trying to identify those new and brilliant innovative companies who may be small, who may not exist yet, but will be developing the technologies to help deliver this green revolution, on this Green Deal, as we call it. So that's the two things. So we're on this sort of twin track with the twin transitions that we want to try to achieve. And of course, we're never going to have a green transition. We're never going to manage carbon neutrality without a huge amount of new investment. Okay, so this is what we've been talking about today, how to direct this investment in ways which make the most sense socially, environmentally, etc. The big problem we're going to have, of course, is greenwashing. You alluded to that. And how we're going to manage the process of conversion in a way which we're not just painting the world green and carrying on as normal. Yeah? But you're right to say that the European Commission has been thinking quite hard about how to provide a framework to support finance in the ESG area. So in 2018, there was the Sustainable Finance Action Plan that came out. I'm sure this is not news to most of you. And there have been the Sustainable Finance Regulations, and a new corporate reporting directive has come out. Maybe I talk more about that later. And one of the key parts of this action plan that came out in 2018 was the EU taxonomy. So we want to try to have an agreed basis on which everybody is going to say, that is green, a green activity, and therefore you can invest in that activity and you can report your investments in that activity. And that is maybe not so green. And the big political debate, as I'm sure you're aware, is whether or not nuclear power is green or not. But regardless of whatever is decided about nuclear being part of the EU green taxonomy, it's clear that we will need transitional technologies, gas, nuclear, whatever, before we arrive at this kind of green pastures in the distance where we will be sustainable in the way in which we are generating power and electricity in our lives. So just to be clear about what this EU taxonomy is, for those who don't know it. So it's a classification system for sustainable economic activities. And with this, we want to signal to the market where we think investments could be deemed to be sustainable and on which they need to report under the reporting requirements established under EU and national law, of course, and international law, international accounting standards too. So there are also, of course, technical criteria, to screen which activities are considered environmentally okay and which not. So we see it as a tool really to help investors and companies, a tool to help issuers or project promoters as they're imagining their own transition to a low carbon environment. And importantly, financial market participants have to use the EU taxonomy when they disclose their share of investments in particular economic activities, whether they're listed or not. And they also have to say whether or not they've invested in particular financial products, and whether or not those are deemed green or not. Okay, so we know that large companies have to disclose their share of turnover from investments in taxonomy-aligned activities. When I say taxonomy-aligned, I mean those activities linked to the or listed in the EU taxonomy. Okay, so that's the first thing. It's a listing, and you have to reach a certain share, or at least report how much you're investing in those listed activities. That's the first element. Second element is, we're working on a sort of eco-label for financial products. Green bonds, maybe sustainable debt instruments, transition bonds. How we're going to do that is not entirely clear, because, of course, when you're involved in the debt markets and this way, that's not so easy. But we think we should make some progress with member states. And we're also looking at ways in which we could clarify the obligations and duties of asset managers, and institutional investors as regards their own sustainability, their own investments in sustainable activities. And last but not least, strengthening the transparency obligations and disclosure of companies' own environmental policies. And we'd like these to be incorporated really inside companies' own risk management models. And now there's a lot of kind of support for this. I mean, you've seen how in the last few years, the ECB and the IMF and everybody, they've suddenly caught up with the world of, climate change and how to respond to this. And so I think they've also been driving, in a sense, the financial community to consider their own responsibilities with regard to supporting the transition that societies need to go through. And of course, the financial sector has a huge role to play in financing the transition to a more sustainable society. And this is not just a European problem, it's a global problem. We've got COP26 coming up. Everybody hears that this is now the last best chance for the world to make it all happen. Let's see if that's so. But I think it's absolutely right and appropriate that a forum like the G20 is able to sort of take these issues beyond the European Green Deal and into this wider international arena. And I think that's really important. There are challenges, there are challenges to how we're going to handle this. One of which, notably, is inclusiveness, and I think we've been speaking about that before, and I'd be very curious to hear what Magda has to say about the sort of inclusivity issues. And then there's another big challenge that we have, I think, to face, which is, and here I speak as the Chief Data Officer of the Commission's Joint Research Centre, and we, by the way, we have mountains of data. You think you've got a lot? We have a lot. From nuclear data, from all of our reactors that are sort of still going on, to mobility data, to telecoms data, to car data, you name it. We have our own laboratories, genomic data, we've got a lot of this stuff. So I understand the challenges of handling a lot of data and making it work. And one of the big challenges here is going to be, how do we make sufficient data of the right kind available to financial market participants so they can then translate this data into useful decisions, to allocate capital in the most sensible way. Now here, we've started this process of disclosure requirements for companies, a long time ago in EU law, and now we've expanded it, I think, to cover about 50,000 companies in Europe. 50,000 companies, sounds a lot, but when you think there's 25 million SMEs in Europe, this is not even the tip of the iceberg, But there's no way in which the European Union can mandate disclosure for 25 million companies. I mean, this is sort of politically sort of fantasy, So a lot of the onus is going to be on national governments, national regulators, to see how they can make these disclosure requirements work in the most sensible way at national level, without, hopefully, muddying the waters of the internal market of the EU. So there has to be some kind of comparability. And one of the things that we were thinking of establishing is a kind of single access point, a European single access point, where all of the reported company data could be somehow collected into a monster portal, let's say. And this would enable participants in the market to see what's there, to compare, but would need to make it machine readable, all this information. There need to be APIs that could allow people to sort of go in and extract the information they want. So there's a lot of thinking and work needs to happen before we get there. But I think it's probably the right approach. How will it be funded? How would a single access point for all of this company information around Europe be funded? It's a good question. Should taxpayers fund it? If taxpayers fund it, presumably taxpayers, or at least government authorities, would then also have management rights over it. So we're not clear about that. the scope of the information to make available, the kind of specifications, how this information could be reused, etc. So there's a lot that still needs to be sorted out. But I think collection and dissemination of data, of relevant data that shows metrics that are clear and can support investors in making wise decisions about where to place their money is very helpful. And if we can do that, I think we'll have gone some way, I think, to at least scoping out the problem and helping to create the beginnings, at least, of a financial regulatory framework that could support the actions of the private sector.
Thank you, Matthew. Definitely the GRC is one of the best kept secrets of the European Commission. You widely cover the green aspect of sustainable finance. But as we said at the beginning, there is also the social side. And we should pay attention to that as much as we do. Actually, there is the taxonomy is considering to include also a social dimension. But probably it's useful to see what's in another universe is happening, looking at the social dimension and in particular inclusive finance. Magda, would you share your work over the last year?
With pleasure, but first allow me to thank as well Consob and Consiglio di Stato for hosting us here in this wonderful place, and especially President Savona and Francesca Medde and Filippo Ardari for the invitation. If we wanted to define very shortly what inclusive finance is in a wide perspective, is finance that favors inclusion, of course. But what is financial inclusion? Here we have a definition that dates back a bit earlier compared to ESG finance definitions. Financial inclusion means that individuals and businesses have access to useful and affordable financial products and services that meet their needs. Transaction, payment, savings, credit, insurance, delivered in a responsible and sustainable way. So here the perspective is really that of users that have to be included in the financial sector. It's a definition that basically dates back to 2010, when the G20 created the Global Partnership for Financial Inclusion, which is an inclusive platform that deals, that pushes, that works with the G20 and non-G20 countries to endorse financial inclusion around the world. So I will concentrate a bit more on a general concept of inclusion rather than focusing on ESG and green finance. The starting point of the work of the Global Partnership is that greater financial inclusion, even when we proxy it with very simple measures, and unfortunately I will say a few words about that, we don't have two good measures. Greater financial inclusion brings a reduction of inequalities, a reduction of poverty, and even an enhanced growth. We have now academic work and work by IMF, by the World Bank and others showing this. And what we observe over the last few years is that the increased digitalization in finance can be a source of enhanced inclusion, but we also observe dangers of digitalization in finance that might create new risks and even further exclusion. As I was saying, we do not have, as for ESG parameters, to evaluate what is truly inclusive. We have data on access to finance, especially for individuals. The World Bank has built since 2011 indicators, the Findex indicators, telling us how big a percentage of adult population accesses finance in terms of basic accounts. And now they are developing more sophisticated measures, but I mean, the problem there is how to measure correctly financial inclusion. So the latest data, which refer to 2017, the World Bank is building now the new wave of index, but 2017 data showed that a little less than 70% of adult population across 114 countries had access to a basic account, with huge disparities across countries, across gender, across segmentation of the population. Given that we don't have indicators those we are building for ESG finance as well, we are working on the conditions to ensure that digitalization in finance is actually a source of inclusion, and during this period also helps coping with the difficulties of COVID-19 and reduces the risks of exclusion. So we are working on context conditions. Working this year with the GPFI, we have seen that in the countries around the world, G20 but also non-G20, we have had many interesting approaches, and that among the most essential conditions to ensure greater inclusion and reduce risks of exclusion are, of course, those referring to the existence of digital infrastructure and connectivity, digital IDs, structures that favor the interoperability, forms of regulatory flexibility, but we focus specifically on two areas, which are consumer protection measures, with a specific focus on vulnerable groups, and digital financial literacy. Basically because the issue of infrastructure was covered by other G20 groups, and these two issues, consumer protection and digital financial literacy, are probably among the most relevant enabling factors to ensure inclusion. We worked with member countries and with implementing partners, and we delivered a set of indications, and if you want, we can discuss them a bit more in detail.
Thank you very much. Clearly, there is quite a lot of work to do in this area. And so I would linger a bit further with another expert in the area, in particularly looking at not just the G20 countries, but also emerging economies. Karin, I would pass the floor to you. Karin, are you there? Yes. Can you hear us?
Yeah.
Hello.
I can hear you.
Welcome.
I'm here.
Would you expand on the social angle, sharing your experience, please?
Yes, thank you very much. And I'm also very happy to be part of this panel. And I think that while we are coming from, to some extent, different backgrounds, I also think that there are many common denominators in our experience and background that we can bring to the table. And there is quite a broad scope of the question, but I would like to address the question and share with you my line of thought on basically how nothing is new under the sun, how different investors' perspectives are coming to emerge to some extent, public sector, private sector, philanthropists. And then also address what was the question in the introduction around how can regulations and regulators help to move the needle for more finance. And this is in essence the mandate of Nordic Development Fund. I hope I can say a few more words and give some more concrete examples of what we do. But in essence, our mandate is to bring more finance to address one of the biggest challenges of the time that we're living in to bring more finance to fight climate change in emerging markets. This is also very much the topic of the upcoming COP, where I'm sure that the question about the 100 billion that has been to some extent promised for emerging markets will be a question that will be asked, and answers will be expected on that. But so back to the line of thought I wanted to share with you. Nothing is new under the sun. And while we talk about the terms of sustainable ESG impact investment and how this has become more prominent in the last couple of years, this is actually something that has always been the focus of public sector investors and philanthropists to some extent. And it all boils down to the objective of addressing market failures, market gaps when it comes to the public sector investors, and for the philanthropists to look beyond the financial return of an investment. So, as I said, nothing new under the sun. This has always been the objective, but perhaps 10 years ago we didn't talk about it in the terms of sustainable ESG and impact investments. What is happening now is that this has also become the objective of private sector investors. And I think that you can explain it from two vantage points, the vantage point of risk and the vantage point of opportunity. Private sector investors, they of course have to address risk, and the risk that comes with ESG, environmental, social and governance. That is also sometimes referred to as compliance. But what is really new is also the realization that to address the risk, there is the other side of the coin, the flip side of the coin is also the opportunity. And here, of course, the market requires that private sector investors, they address this opportunity as well. There is also a value creation aspect of addressing ESG and sustainable finance. And this is why we see all these focus on these matters. And to some extent, we already touched upon the risk of having private sector investors, fund managers doing greenwashing. But on the other side, I think that this is something that we have to expect and that we should also to some extent welcome, because in the end, there will be more focus on sustainable and impact investment finance from that perspective. So all in all, the perspectives are emerging between different players in the market. Public sector, private sector, impact investors, and the ones that comes with the philanthropic perspective. And more finance is needed, so all good. Then also a few words on how regulators can help to move the needle. And I think that the answer to that question is yes. They can, and we already heard from one of the. We already heard the discussion and the great explanation on the EU regulations that will definitely help to move the needle. But also, I think that the voluntary regulations, such as the task force on climate-related disclosure, and the GRI, the Global Reporting Initiative, which has been around for quite some time now, is something that will help to move the needle. So all in all, my take from this is that there are some intrinsic drivers that will help to crowd in more investments, more finance from the private sector. And there are also regulations that will leverage on this intrinsic driver. Thanks for the time being, and I'll be happy to come back.
Thank you, Karen, especially for this call for optimism. But I think we cannot close the circle if we don't bring the voice of the private sector into this discussion, and in particular, such an eminent player in the field of digital finance as MasterCard. So, Mike, the floor is yours.
Well, thank you very much. And first of all, it's an honor to be part of this. Filippo, you left out of my biography that I was the G8 and G20 Sherpa for a long time. And my first summit was hosted by the Italians. I just want to congratulate Italy for its G20 chairmanship and for furthering this agenda so well. Let me build on a couple of the comments that have already been made. First of all, the flow of funds into ESG areas is impressive, as is the expansion of the green bond market globally over the last few years. What it means, however, is much less clear. Most of the investors, the vast majority of investors we speak to, among the active investors, view it as a negative screen to exclude companies or bonds from companies that are, in their view, not good players on ESG. But very few use it as a positive weight. What you're not seeing is investors overweighting their allocation of capital to companies based on higher than average ESG scores. As of now, it's a fast evolving market, but currently you're not seeing very much of that. And the question is, what will it take for that to happen? One is clearly the metrics and the ratings. As Filippo said, there are more than 600 different assessment solutions out there all over the map. There's some efforts to consolidate them. Work, for example, by the World Economic Forum and the big four accounting firms to try and come up with a comprehensive framework. But there still are way too many out there for companies to react to. Beyond the quantity, though, I think we need to look at the quality of the metrics. What kind of behavior are they incentivizing? And there, I think there's vast difference between the E, S, and the G. On the E, it's relatively clear because there are comparable metrics across sectors, reducing greenhouse gas emissions, getting to net zero, scope 1, 2, and 3, some open issues around credits, the use of carbon credits, and what constitutes the nature of the credits, but there is a beginning of a coherent set of metrics around there. On G, it's relatively clear. A lot of focus on corporate governance, on ethical business practices, articulated in one way or the other. S is a mess. And while Larry Fink calls for companies to have social impact, and the Business Roundtable, the group of CEOs in the United States, says companies have an obligation not just to shareholders, but to a wide range of stakeholders, the S metrics as they are currently written don't really help. Most of them are focused on labor practices, which is a very important set of issues, how you treat your own employees. But for a company like ours, and like many companies, particularly in the services sector, whether you pay minimum wage is not really the issue. Some have a small throwaway line about impact on local communities or others. But what they're not doing is incentivizing companies to have a positive impact on society as a whole. And that's because it's hard to compare S activities across one sector from another, one company to another. Let me build on what Magda said about financial inclusion. That's an area we've been involved in for over a decade. And we've brought more than 500 million people into the financial system. We work very closely with the World Bank and Findex. And as Magda said, access is not enough. We now have to think about usage and financial security and financial health, financial literacy. Are these tools, the digital tools, actually improving the lives of these people that they're intended to support? But those kinds of activities, as Magda alluded to, are not really included in S at all. And it's not about getting credit. It's more the question about how do you want to incentivize positive corporate activity? And until there is that kind of incentivization, you're not going to get it at scale. And that goes back to the market piece. And I'll give you one example. We issued a $600 million sustainability bond earlier this year to support our green activities as well as our financial inclusion activities. Wildly oversubscribed, lowest rate for that tenure ever, modest premium, modest reduction of the spread compared to non-sustainable bonds. The more companies see that spread between sustainability bonds and non-sustainability bonds being significant, the more they're likely to see the right incentives to act on sustainability. Similarly, on the equity side, the more that they see managers overweighting good players, not just screening out bad players, the more they're likely to act in that side as well. And that, let's just conclude, that does bring you back to the question of regulators, who can play a critical role in issuing clear, consistent metrics that incentivize the right behavior. And I think here's a critical role for the G20, because anything that requires multiple regulators to hopefully come up with similar or comparable outcomes, the G20 can play a very useful role. I understand earlier in the day, it was suggested that the G20 create a permanent line of work in this area around sustainable finance. I think that would be a very positive contribution coming out of that line. Stop there.
Thank you, Mike. You nail the issue. I mean, probably I will end up quoting you saying the S in ESG is a mess. It's actually very simple and powerful at the same time. But let's move to the outcomes. The shared goals of sustainable and inclusive finance in all its expression is to empower people and protect the planet. Theoretically, digital innovation could be a powerful enabler, but in practice, we have witnessed the rise of fintech, but little on social and environmental impact. I would not be surprised if just a few in the audience had heard of green and sustainable fintech. Now, let me recall a case, M-Pesa, the mobile phone payments developed as a charitable initiative in Kenya by Vodafone Foundation. What started as a humanitarian intervention, it turned into a very profitable and large industry. This at least points in an interesting direction about the potential of those social environmental dimensions. This is the occasion to share cases of this kind. Magda, shall I pass it to you?
Then I will start with this example because it's a wonderful example, the mobile payment industry in Kenya. An example of how innovation in finance can be a source of inclusion. There it included millions of people starting through payments and then allowing them to start saving through these mobile payment instruments, building a history of data, and then being able to get an access to credit. So innovation and digitalization in finance can be a source of inclusion, an inclusion that can reduce poverty and inequalities. But since it also has negative sides, we have to work, as I said before, on the conditions. And as I was saying, I can elaborate a little bit on the conditions. We have worked this year with the Global Partnership together with other partners. We have worked with the World Bank, with the OECD, with the SMEs Finance Forum and IFC, who have worked with us in understanding how digitalization in finance during the pandemic helped, first of all, to address the impact of the pandemic itself. Digital payments have been pushed everywhere in various forms, and they've helped enormously in a number of countries to reach the population with the support measures, the government support measures. And this has actually produced greater inclusion and might produce also permanent impact also on behaviors of people. We observed some of these, for example, support measures that were received digitally produced more investment by families, by households in the education of children rather than other expenses. They produced greater resilience of households. They produce greater empowerment of women rather than cash support measures. The increase in digitalization in some markets have helped also other types of markets like the remittance markets. Everybody expected that there would be a decrease, a reduction in remittances due to the difficulties of migrants in sending back money to their families. But actually this has been happening only in a limited number of countries. In many countries, actually, remittances stayed or even increased and moved from the informal cash-supported instrument to more formal and digital instruments, helping somehow also the inclusion of both senders and receivers. So these are all the somehow positive sides of innovation in finance and digitalization of finance. Of course, there were also difficulties, even in the support measures for some vulnerable groups. Think of elderly. Even in the UK, it was difficult to reach elderly people with digital support measures, or people in rural areas, underlying the importance of moving into digital instruments with caution and having in mind that some traditional instruments have to remain somehow. Now, how to make sure that these progresses are here to stay? As I said, we worked on two main areas, two main, say, enabling factors to ensure that digitalization produces inclusion, especially for the vulnerables, women, youth, elderly, migrants, forcibly displaced people, and limit the risks of exclusion, but also other risks. And as I said, this area are financial consumer and micro and small enterprises, protection, and digital financial literacy. Building on the reports that these implementing partners produced for the global partnership, we developed what we call a sort of distillation of these effective approaches that we observed across countries, and we produced a menu of policy options for these two policy areas, which we organized into three areas. The first is policy options that help addressing the impact of the crisis, but also thinking ahead. That is, ensure that at least some of the support measures are enter into protection measures in a structural manner. A second area is how to leverage digitalization for a leap forward in financial inclusion. Not just going back to as we were before, but enhance in a substantive way inclusion. And the third is addressing new and possibly exacerbated risks of exclusion and vulnerabilities. Let me give you just some examples from each of this area. The first area, as I was saying, support measures, but also thinking ahead at the same time. For example, incorporate some of the hardship measures that were used during the pandemic into more structural protection frameworks. There were some regulations that were adjusted, that were some limits to use of cash that were, or use of digital instruments that were adjusted. Well, these could enter into structural measures. Or widening the range of responsible financial instruments available to vulnerable groups. Or one approach that we observed across countries that really worked was adopting a coordinated multi-stakeholder approach across public institutions working together into working groups, other forms of cooperation, and public-private cooperation. This has really worked. Second area, digitalization for a leap forward in inclusion, favoring protection by design. That is, the regulators, the supervisors should push producers, financial companies, to introduce new financial products, having in mind the real needs of finance users. And we already have in Europe regulation in this direction, product oversight and governance regulation go in this direction. Also for other countries, this could be a good example. Data collection is a major issue, and digitalization is helping this. Use behavioral insights to improve both consumer protection and financial education. And we have examples of how behavioral insights, for example, using apps that ensures that people are reached in the right moment and change actually behavior is a good example. And inclusive digital financial education is another important area. Digitalization has been used a lot to do financial education. There are a lot of tools that have been proved useful, but we have to keep into account that some vulnerable groups are hard to reach with digital instruments, so we have to use also more traditional instruments or at least simplified digital instruments. Third area, addressed risks. Here, it's important to keep working to identify groups at risks of exclusion, vulnerable groups, so supervisors and public authorities should keep working on this, collecting data, address the major risk of fraud, scams, and data privacy. This is a challenge for all of us, I think. Introduce or reinforce redress mechanisms. This is very important in a changing world because consumers might be scared by digital instruments because of scams, because of frauds. So having redress mechanisms that help them when something goes wrong helps reinstating trust in the financial system. And then using digital tools also by public authorities to improve their work, their way of supervising markets. So this is a summary of what we concluded with our work.
Thank you. And Karin, you also have quite an experience in this area to share with us.
Yes, thank you. And I think that was already touched upon that innovation also means innovation in financial structures. And this is something that I wanted to share with you some experiences from. And I think it's also all about recognizing that to be able to crowd in more finance, for in the case of the NDF, the nexus between development and climate, you need to come up with financial structures that can meet the diverse risk return expectations from different sets of investors. So how we do this is that our focus is that we then can provide financing for very early stage, meaning that we can provide financing for actual structuring and design of projects and investment vehicles, that we also come in very early as the first investor and providing catalytic finance. And then across this, we have the opportunity and the great advantage with working with everything from grants to loans to equity that we can then mix, and we can come up with the best possible structure that meets the needs of the investment vehicle. And of course, I mean, we cannot do everything. As NDF, we're quite a small institution, but we all know that to be able to bring more financing to solve these problems, we need to go from what is many times referred to as millions to trillions. And taking a look at the global financial landscape for climate finance, the most recent numbers were that financial flows were approximately $630 billion US, and out of these for the global landscape, not just for emerging markets, and 50% of these came from public sources. And then when we look at the private sector finance, the 90% is for mitigation, where we realize that most of the financial gap comes from the needs stemming from adaptation finance. So there is clearly a case to try to bring more of investments into this sector to close the gap if possible. So from our perspective, what we're doing then, as I said, we do early stage, we do catalytic finance, and we use the instruments that we have in a flexible way. And we try to also provide financing throughout the continuum. We know that there is this concept of the missing middle after companies has received the first financing for the launch of their business, then there is a fundamental lack of finance to take these companies to the next phase. So this is what is referred to as the missing middle, and where there is a need to bring more financing into the equation. But there is also a need to work in a top-down manner to try to bring and crowd in financing from institutional investors. And for the segment that we are in as NDF, climate finance in emerging markets, that is not so easy. So here we have to come up with structures that bundle investment opportunities, such as fund structures, and where we, as an investor with not any specific return requirement, can come in and provide the so-called private of the first junior equity tranches, and even grant tranches in the structure to crowd in more investors. We're doing it. For example, we have worked with the African Development Bank. We often work with the bigger institutions, and where we have then financed the structuring of a impact investment fund in the renewable energy space. We brought it to the market. We procured a fund manager, and we provided the first loss tranches of in the equity structure, and bringing more investors into this structure so that this vehicle could become up and running and then start doing investments. So this is one way of working, and the other way, as I said, also the bottom or the top-down way, where we, together with much bigger fund managers, can contribute to crowding in financing from institutional investors. So yeah, a little bit about how you can be innovative also by providing innovative financial structures. Thank you.
And Karin, just for our knowledge, because I might have missed that, would you refer to a sample of countries where you operate, just to orientate us geographically?
Yeah, I mean, it's our focus is low-income countries, and since many low-income countries they can be found in sub-Saharan Africa, our focus is also sub-Saharan countries. So approximately 60% of the portfolio is directed towards sub-Saharan Africa. But we also have investments in Asia, Latin America, to some extent, where the main focus is towards low-income countries.
Thank you, Karin. Definitely challenging environment. Mike, moving to you. MasterCard has had a long-term experience working with both inclusive finance and sustainable, environmentally sustainable finance. So oops, we missed Mike.
No, I'm here.
Ah, you're back.
I'm here. I can see you.
Okay, as long as we can hear you, that's enough for us.
Yeah.
So,
there we go.
because you have some interesting experience in this field also, on both sides. Would you share some with us?
Sure. I think among the many lessons of COVID has been just how important digital inclusion, digital connectivity is. Whether you're an individual expecting support from your government, or a small business trying to move from being a brick and mortar store to going online and staying in touch with your customers and suppliers. or a government trying to serve their citizens more efficiently and effectively. It's all accelerated trends that existed before COVID in terms of underscoring the importance of digital connectivity. But as you said in your introduction, it's very important that we make sure that we're not opening up new digital divides, but that digital innovation are creating bridges. And I think there is great potential there for digital innovation and all of the players in that ecosystem, whether they be platforms, networks, fintechs, as you mentioned, and others, to contribute in their own way through innovation to this effort. We've been working with a number of companies through something called the Edison Alliance to lay out a series of principles about what digital inclusion really means and how does it apply to financial inclusion. Issues around making sure financial products are inclusive by design, digital by design, interoperable, commercially and economically sustainable over the long run, so they can continue to be invested in. And then creating partnerships with other companies to try and bring those innovations to the market. I'll give you two examples, one from the area of financial inclusion and one from the area of sustainability. On the financial inclusion side, just to build on Magda's comments, we have been working, started in Kenya actually, with Unilever and a local bank to digitize the relationship between a small micro merchant, those little stores at the end of the road, their Unilever supplier, Unilever being a big consumer products good company, and a local bank. And transactions that used to be invisible because they were done in cash, now we have the data set to look at it, and more importantly for the bank to look at it and get comfortable serving a market they had never served before. So providing credit to that micro merchant, who's oftentimes it's a woman-owned business, can then buy more from Unilever, serve their customers better, and the bank is comfortable or confident they'll be repaid because they've seen the data flows for a period of time. We've taken that kind of supply chain model now with the Asian Development Bank to Indonesia, with the European Bank for Reconstruction and Development to Turkey. I think it's a model of how you use digital tools, appropriate data analytics to bridge gaps that previously existed and help get people the kind of financial support they need to grow their business, to add jobs, create greater financial security. Second example I'd give you is in the climate change area. Again, how do you use digital innovation in this area? We launched a coalition a couple of years ago called the Priceless Planet Coalition. It's now about 70 customers who are part of it. We're committed to plant 100 million trees over the next 5 years. And as part of that, we launched a sustainability lab in Sweden to help develop innovative products that will be addressing sustainability issues. First product coming there is a carbon calculator that you can calculate your carbon footprint as you spend money and then immediately take action to offset it, not through a carbon credit, but by planting trees through a nature-based solution. And the advantage that we have is that we're a network in 210 countries, 3 billion cardholders, 70 million merchants, 25,000 banks, that you can come up with a digital innovation like that addresses the behavioral issues around climate change. You have the potential to bring it to scale globally, and so that you can ultimately have a big effect. That's the kind of thing that we can do. We're not an oil company, but we don't have a big carbon footprint as a company. Every company, though, has those kinds of assets to bring to the table. And I think the challenge is for every company to figure out what are the totality of its assets that could be relevant and through innovation could be brought to market to address the kind of issues that we've been talking about. It's got to be genuine and authentic to the company, or it will never last. It's got to be sustainable over the long run, otherwise it will never scale or be continued. But if you can achieve that, you really have a very significant impact from the private sector's point of view, contributing to the efforts that governments and philanthropies and the social sector are already contributing to.
The carbon calculator is actually a fantastic initiative for two reasons, because it means that you bring to the retail market the means, a simple tool for people to understand their impact in terms of carbon emission when they make a single purchase. And moreover, it's completely aligned with your business. So it's a very great example of what every business should do. So do what you're good at and do it sustainably. Thank you. I love that Swedish case. I would move to the third and last question that looks at the impact of sustainable and inclusive finance. Because ultimately we are all here for impact, to make a difference. It's true that there is, and we have seen regulation happening, the market moving, but I describe it as a Concorde flying over our heads, because most of the focus has been on the top market players, large corporations, institutional asset managers, financial products. But there is an elephant in the room, which is the real economy, or small and medium-sized enterprises, which have been overlooked in general. And those small-sized companies also include the startups, which are the source of innovation. When we think about clean tech and the innovative solution to tackle climate change, it's not something to be dismissed. The G20 has a focus on SMEs. So it's certainly a good test for all of us to look at the impact of those very important changes on the ground, taking the case of SMEs. And I would, Matthew, start with you, because SMEs are important for the European Commission as well. I mean, despite what we have been taught, there have been programs and policies related to SMEs for a very long time. Now the challenge is new.
Yeah. Let me just start replying to that. So I read an article in the Financial Times, I think it was a week, 10 days ago or so, about ESG. And basically the person who was writing the article, a very eminent person, no doubt, was saying that the problem with ESG is that it's leading to mispricing of companies. Yeah, there's so much out there. Why do we have all this regulation? Just let the companies or the investors just decide what they're doing themselves. I mean, it's a valid point, but on the other hand, we should not let the best be the enemy of the good. We have to start somewhere, I think, with signaling in an appropriate manner to the market where we think investment is needed in the future. Okay, so we need to do more. We've heard, I think, from Mike, from MasterCard, that the issue is there's so many different solutions out there. When are they ever going to coalesce? Yeah. So it's very difficult for people to make appropriate investment decisions now, understood. But there needs to be some signals given. And I think regulators do have maybe a chance to think about some metrics, some baselines, some standards that could help. I think I mentioned the Sustainable Finance Research Forum that I think is going to be established by the European Commission between academia and industry that should maybe, hopefully, sort of kick off this debate. We get somewhere with that. I mean, let's be clear. What's the risk here? The risk is that, we fail to invest appropriately in new technologies that would help us meet our climate targets. Yeah? So it's not nothing we're talking about here. And if you think about climate targets and reaching climate neutrality, I mean, I hate to keep on banging the drum here, but we will never reach carbon neutrality with the existing portfolio of technologies we have today. Yeah? The technologies we have today are not sufficient to reach climate neutrality by 2050, 2055, or whenever it is, 2060, whatever jurisdictions are deciding. So we will need new technologies. Yeah? These new technologies need to be discovered by the market. These companies do not exist today, or maybe they exist in laboratories, or very small startups are funded or sort of spun out from research organizations. So these need to be identified, they need to be found, and they need to be scaled up significantly, because, of course, as we transition into greener technologies, our need for electricity increases massively. Yeah? So this is almost an exponential problem. And the other reason is, I mean, speaking from a very sort of, let's say, small-scale European point of view, if we fail to keep up with technological developments that we can see happening in other parts of the world, we will fail to provide for our future, in terms of the prosperity in our way of life. So we need to be investing in technologies in a way that other jurisdictions are successfully managing to do so at scale now. Okay, and one of these technologies that we will need, of course, is some kind of fintech. Okay, so let's stick with that. I mean, not with necessarily the green technologies, but if we look just at the finance industry, we need to be able to create the sort of financial environment, or regulatory environment, I should say, where fintechs would have the opportunity to scale up. So I think we said before that there's something like 25 million SMEs in the European Union. We reckon about 600, well, I mean, who knows, probably 700 by now, types of sort of different ESG metrics around there. So we need to be providing the sort of support to identify these fintech companies. Yeah, the European Commission does that, but so do many, many other organizations. And I think this is a case of we have to let 1,000 flowers bloom, so that eventually the best ones will find their way to market at scale. We need, I think we spoke earlier, or the previous panel spoke about digital infrastructure, digital quality, or data quality. I think that's really right. The G20 has a role here in providing a sort of a signal to the market and to financial market participants that this is important enough that there will be public sector support for the development of an identification of fintechs. And then it's up to the private sector really to see if they can scale up the right ones that will be the easiest to use, that will have the widest possible base of support. Absent that, we're not really going to get off the drawing board. If you think in Europe, we're relatively strong in the manufacturing sector. So, I mean, there could be ways, for example, in which you could think about the Internet of Things and sensors of the Internet of Things being used to provide real-time data about, what is being emitted by a particular factory. You could create a digital twin of a company to allow people to consider not just sort of business decisions, but also sort of environmental sustainability decisions. These are the sort of innovations that we can imagine, But I mean, it's not enough to talk about them here. I think the best we can do now, I think, is provide that kind of provide a space, a forum that the G20 can provide, which is a good place to do that, to signal to the market and to startups that they are required, they will be needed, and the regulatory sandboxes or the living labs will be there to help them scale up. Actually, the Joint Research Centre is a living lab of its own on two of our sites, one in the Netherlands and one in Italy, in northern Italy. So we actually provide already sites for at the moment, energy companies and people dealing with drones and smart grids and stuff. But this is part of the solution in which we can think about providing support, real practical support to smaller startups, SMEs and others that will get this fintech sector off the ground in a way that will really support broad-based uptake of ESG reporting throughout, the vast mass of the real economy. And that, I think, is something that we truly need.
I think you're completely right saying we are not going to tackle the issue in this case, but at the same time, this is a great opportunity, as you said, to raise this issue and putting under the spot echoing what also has been said in the previous sessions and the presentation of President Savona on potential follow-up. Mike, so what do you think on this SMEs issue on the other side of the Atlantic?
Well, a couple of issues. First, I think SMEs are the backbone of every economy around the world, developing. And we saw, again, during COVID, just how vulnerable they were. I think it puts a premium on us to come out of this current crisis, to borrow a phrase, to build back better, that we're actually making it possible for small, medium-sized businesses to get digital, to get paid, to get access to capital, to be able to operate in an online e-commerce way in ways that they probably previously had not done. And we see a lot of evidence of new business creation all over the world, online, completely digital-first business creation that's happened because of COVID. When it comes to fintech, I think it's a very exciting area, and there's so much innovation going on in the fintech space, including fintechs touching on sustainability issues. And I go back to the carbon calculator as an example, because that was actually started by a startup in Sweden called Economy. The partnering between fintechs and large companies, to me, is a really powerful model, taking creative new ideas and then getting them to scale globally as quickly as possible, really emphasizing those kinds of partnerships. It goes to just thinking about the market having an effect. Last thing I would say is I think one of the most powerful market-driven engines for sustainability, including with regard to SMEs, is the net zero initiative, because as all of us in large companies wrestle with our scope 3 emissions, those are all in our supply chain. And it requires us to work with our supply chain, which may be large companies, but there's also a lot of small and medium-sized businesses in that supply chain, to help them get to carbon neutrality. And a number of large companies getting together to help their common vendors get to carbon neutrality sooner than later, that's going to help provide that kind of support that's going to be necessary for them to play a role in this as well. So I'm optimistic about the role that SMEs can play, that fintechs can play in partnership with larger companies.
Thank you for making this connection between fintech and SMEs, both Matthew and Mike. I shouldn't say more because we are starting a new venture on sustainable fintech for SMEs, but it's not my time to give a talk. While on the other hand, I'd like to pass the floor to Magda, because you have within the SMEs, you have looked into, in particular, micro SMEs, which are very important in, everywhere, but certainly in emerging economies.
Yes, micro and small enterprises were a particular object of observation as vulnerable groups. A very important group for inclusion, for financial inclusion for the GPFI. They were heavily hit, of course, by the pandemic, even if with a huge variation across sectors, across gender as well. But the pandemic also increased the use of digital tools among many of them. At the same time, public support measures, in many cases, leveraged digital technology and public data, and somehow facilitated the use of digital services, so pushed for digitalization of smaller companies, even micro ones, and private solutions as well, by traditional lenders like banks, which streamlined in many cases their MSMEs loan application procedures, or created new digital payment solutions, or for big tech and fintech, delivered new or updated financial products and services. Crowdfunding platforms, of course, were very relevant. new instruments for traditional credit assessment, but also insurtech companies were provided support to micro and small enterprises. Of course, they were heavily exposed to all the risks that we were citing before in general. So micro firms as well were exposed to cybersecurity risks, financial fraud and scams, and digital financial divide. Especially concerning this point, we developed, together with the OECD, a specific survey on financial and digital competencies of micro and small enterprises, because we don't have data on this across countries. So we did this survey for micro firms, 1 to 9 employees, and small firms, 10 to 49 employees. And we have preliminary results, not a large number of countries, 14 between G20 and non-G20, but what we observe and was somehow expected is that they have a very low level of financial literacy, measured by knowledge, behavior, and attitudes. Less than 30% of these sample, which is in most of these countries the representative sample, has a high level of financial literacy levels. One interesting point is that we don't observe in general gender differences across micro firms in terms of financial literacy. We observe differences in terms of the owner's level of education. We also have a low level of digitalization before COVID for micro firms that was measured through this survey, both in terms of use of financial services, but also other selling practices, digitalization in general. But for many of them, there was an acceleration, especially for those with the most need of cash during COVID. So that was a push for digitalization. Financial literacy, for those who had already a reasonably good level of financial literacy, was positively associated with resilience during the crisis, to awareness of public support measures, so this helped resilience more, to access to credit, and also to more rapid digitalization. So what we conclude from this is that financial literacy matters for small firms, for micro and small firms as well. We expected that, but we have somehow evidence. Based on all these observations, again, we derived some policy implications, policies that worked in terms of building a more robust, sustainable, inclusive ecosystem for the provision of responsible digital finance for micro and small enterprises. Multi-stakeholder approach, even here, was very relevant, public-private dialogue especially. Having inclusion within innovation policies, that is, when you have sandboxes of innovation hubs, having inclusion as one of the preconditions, as one of the objectives of what you support through these innovation measures. Flexible regulation to somehow include or favor fintech companies, such as open banking regulation in Europe, but in some other countries this is not there. And then, of course, digital financial literacy, using, again, behavioral tools, but also traditional ones for micro firms who were not reached by digital instruments. However, we have a major challenge for GPFI as well, for all those who work on digital and inclusion in general, is work on data. We have a problem. We don't have enough data on SMEs, micro and SMEs finance, comparable across countries, disaggregated by gender. This is the next challenge for all of us, I think. But we take that as a commitment, as the partnership. And in conclusion, I think we can certainly agree that we need a number of conditions to ensure that actually digital innovation is a source for a more sustainable and inclusive finance for all, and in this case for micro and small enterprises as well.
Certainly on your question about data, you might find here in this panel an answer to your quest for sources of data. But towards a conclusion, I would leave Karen to say the last words about this matter before closing.
Wow, that's an order and a challenge. But if I at least try then to bring the different perspectives together to some extent, I think that we can conclude that to address the need for sustainable, inclusive finance, we have to work on many fronts. We have to work bottom down to bring in the big capital and the big corporates, but we also have to work bottom up to bring in the SMEs into the equation. And one thing that has not been mentioned, perhaps to a great extent, is the need to work on the enabling environment as well. And this is also very much the focus of us as a development and climate finance institution, to work with governments and to work with the public sector to provide the enabling environment for both public and private sector projects. And then zooming in on what is NDF's area, that is to work in the nexus between development and climate in emerging markets. There is many facts and to state around the role of SMEs and also the role of SMEs as a source for job creation, where if you ask poor people, and I remember the World Bank did many years ago, what will it take to take you out of poverty? The most common answer is to get a job. And in emerging markets and also in more developed markets, the SMEs, they are the main source of job creation. In sub-Saharan Africa, approximately 20 million young people, they will enter the job market annually. And that is on top of everyone that is already now out of employment. So of course we need to address the needs, the financial needs of SMEs, to address also the unemployment. And here it's very important, and then we haven't even talked about the distinguish between the formal and the informal sector in emerging markets, where most of the jobs, they are actually in the informal sector. But also in the formal sector, there is a complete lack of financing for SMEs. And here we need to think again about what I referred to before as the continuum, that there is quite a lot of money around for the absolutely first phases on the SME's business journey. There is quite a lot of grant money to take companies off the ground, but then when they are off the ground, there is a lack of financing for taking the next steps. So here is something that we try to address. We have some trust funds where we provide grant financing for the first phases, and we try to then work together with partners that provide loans for the next phases to make sure that all the good initiatives that are not lost when SMEs are then on the journey from the very, very first steps to a more sustainable and in the end also inclusive business model. So maybe that will serve as the last words from me, and I'm sure that Filippo will take over and bring everything to a complete understanding from the different perspectives. Thanks.
Thank you, Karen. I hope that we had learned a bit more about what is sustainable social and environmental finance, and we have inspired our audience and the people connected online to do more, and actually there is more to do. I would thank our speaker with a traditional close, and before inviting everybody for a drink, I would also like to thank the Consiglio di Stato, Consob, who has organized this, and in particular President Savona and Professor Francesca Medda, and everybody else who has contributed to the realization of this event with a big applause. You can tell me why. Enjoy the drink.